Good evening, everybody.
Well, hello everyone. Welcome, welcome, welcome. I'm feeling a little short. Can I
I
lower
took
the
my shoes off. I usually take my shoes off to even out our height. Oh, no.
There we go.
Okay.
There we go. Sorry guys. I like to look centered in the frame. Well, welcome everyone. We are excited to be here tonight. This is like a blast from the past.
Mm-hmm.
Community Power Hour
Woo.
is coming back for
Yeah.
August 2026. So, for those of you that are new to us, Nick and I, for years, did a Community Power Hour about once a month. We would just, kind of teach on any topic that came up, teach on what our investors were asking us. We would do a state of the market a couple of times a year. It was a ton of fun. We sunset it kind of loosely about a year ago. When you have 6 kids, the evenings are really, really precious, and the evenings are precious for all of us. But we've had this multifamily underwriting class in our minds for several years now, and excited to bring it out tonight. I think it's a topic that is, perennially valuable, and particularly with how many changes there have been in the market in the last several years. There was a period in 2020, 2021, even early 2022, where it seemed like kind of every deal worked. Like,
Mm-hmm.
rents were going up.
On paper.
Yeah, vacancy was low, all of those sorts of things. And I think a class like this, like at that time, like just wouldn't have had traction. And today, where there's headwinds in the market and expenses are going up, and in many markets, rents are struggling and vacancy is high and those sorts of things, people are hungry for underwriting. So
Mm-hmm.
we're excited to be together tonight and do our multifamily underwriting class. You can go ahead and ask questions as we go throughout the night right in the Zoom chat. We try to keep a close eye on that. And where it makes sense, we weave the answers to the questions in right during the presentation. And then if there's any questions that it doesn't kind of make sense in any particular slide, we answer those at the end. But we really want to thank you for joining us live, and we do so by answering all of your questions. Shall we get started?
We shall.
Yeah, let's go for it.
Yeah, lots of ground to cover, and I'm sure people have lots of questions. This will be a fun, interactive exercise for everyone who's here with us live.
Yeah, absolutely. Pop your popcorn, get your drink, get settled in. I estimate we might go maybe
I had popcorn.
Yeah, well, we'll have it when we get home.
Okay.
It'll be great. I estimate we might go maybe about 2 hours tonight. So stay engaged, stay with it. For the most part, we try to give everything that we can, what I call like podcast style. We get it that you might be driving or with the kids or still in the office, those sorts of things. And then we'll specifically call out if there's really something on the screen. There's a couple times we're going to do some spreadsheets and stuff, and we'll call that out to you. So we'd love if you watch the screen the whole time, but if you do need to step away from your screen, we're going to try to do everything verbally, and then we'll call you back to look at things that are ultra important.
We already have our first question. What is underwriting? I think that is a beautiful question. Underwriting is the process of deciding what it might financially look like to purchase a multifamily property or any potential investment, and using that information to decide how much you might be willing to pay. That's underwriting.
There you go. Good job, Nick.
I think that a lot of Elaine and I's success
right?
is being fearless in asking questions. Like, we sit down with lawmakers and attorneys and these like high-powered people, and we just ask really simple questions like, what is underwriting? And that is a big ingredient to our success. So thank you to the person who asked that question.
Absolutely. Another question came in already. Will there be a recorded version? Yes, absolutely. We will get that out likely tomorrow.
But you can't ask questions if you're not here with us live.
Couple little disclaimers for tonight, just our usual. Tonight is education. Nothing here is investment, tax, legal advice. We have a portfolio, and that's where we get our experience, but we are not attorneys, CPAs, financial advisors. Talk to your own advisors whenever you're making any investment decision. Nothing here tonight is an offer. We're going to weave in talking about our real lived experience in our portfolio, but please do not interpret that as an offer to sell securities or a solicitation to buy. If you are interested in investing with us, you can do so through the usual channels. Make sure you read all the documents, and our investments are available to accredited investors. When we talk about returns, both in the deals that we have and the deals that you're thinking about, returns are always targeted. They're never guaranteed. And you'll see through our underwriting that that is the psychology. There are no certainties whatsoever in underwriting. I guess maybe like the address that you're purchasing is a certain fact, but really like that's about it. There's few certain facts in underwriting, and we're going to teach you how to deal with that uncertainty. And then we're going to share true stories from our portfolio, de-identify the names, but the examples that we have here are actual real examples from our portfolio. Let's talk a little bit about who we designed this class for. So we know that those of you joining us are a wide audience with a lot of different interests, and we want to make sure that you get massive value out of our time here tonight, regardless of your interests. So for some of you, it may be that you own some rentals that you personally own, you actively manage them, maybe you self-manage them, or you have a property manager. And maybe you're thinking about bigger multifamily and you want to learn a little bit more about underwriting. We're going to teach you how to do that tonight. Many of you are passive investors, or you want to be a passive investor and you want to have a better understanding of how to listen to a deal pitch, how to look at a deck, and we're going to teach you about that tonight. And then for many of you, you hear the phrase, we underwrite conservatively. That's a very, very, very common phrase. I mean, it's even something that we say. And we're going to share with you tonight what we believe conservative underwriting looks like and kind of give you the psychology and the mechanics and the way we underwrite. And we've built a portfolio worth about $500 million, but the number of deals that we've underwritten, I mean, it's like somewhat unknowable. It's probably close to like, I don't know, 3 or 4 billion that we've underwritten,
Yeah,
right?
yeah, easily.
Because we say no much more than we say yes. So in order to acquire 500 million of assets, we've underwritten many, many billion. That's what we're going to do tonight. That's what it's here for. Let's bring back Sophisticated Sam and Simple Sally. These are our
Love
buddies.
these people. Yeah. So we just got some kind of pithy, punchy sayings from our commentary crew here, Sophisticated Sam and Simple Sally. Sophisticated Sam, he's got a big old spreadsheet, an institutional grade model. He has an answer for everything, even if he doesn't have a clue what words are coming out of his mouth. And he is kind of dangerous. Don't become Sam. Don't become too sophisticated. Don't become too caught up in your own complexity. Don't mistake specificity for accuracy. You can say that you think rents are going to be $21 and think that that's going to be more accurate than saying rents are worth $20 or rents are going to be $20. We're a big fan of Simple Sally. You'll notice that Sally asks small questions that are hard to answer. She's soft spoken, and she's often got a word of wisdom or two that might resonate with you. And we'll see what kind of wise words Sally has to share with us this evening as we're talking about some fancy things. Just a little scripture to share with you. So regardless of your religious or spiritual beliefs, this comes from Solomon, one of the wealthiest people in the history of humanity. Ecclesiastes 11:4-6. Whoever watches the wind will not plant. Whoever looks at the clouds will not reap. So sow your seed this morning, and in the evening let your hands not be idle. So go plant in the evening as well, for you do not know which will succeed. The original prescription against analysis paralysis. At the end of the day, people tried to do excessive underwriting with really complex models to try to dispel uncertainty. And my friends, you have to become friends with uncertainty. Uncertainty should never be a reason to take less action. Massive action is the cure for uncertainty. That's all there is to it. And you're going to see that theme play out over and over again throughout our presentation tonight. You might say, well, it seems like Nick and Elaine don't know their numbers. No. No one knows the numbers. The people who say that they think they know the numbers, those are the people you really need to watch out for.
If you're new to us this evening, welcome. We are so excited to have you. I'm Elaine Stageberg. This is my wonderful husband, Nick Stageberg. As I mentioned, we have about $500 million in assets under management. We've built that portfolio over the last 15 years. We've raised about $115 million from investors, over 700 investors. We just did a $10 million capital raise last Friday and raised that in a single day.
Woo!
We own and operate well over 2,300 doors. How many doors are we going to have when we close on everything that's under contract?
So 11 months ago, we had 1,600 doors. I just did the math. We're working on some insurance things today. So 1,600 doors 11 months ago. Today we have 2,100 doors. And this is just in Minnesota, not in Tacoma, because it's for Minnesota insurance. So 1,600, 2,100. And then when we close on everything we have under contract, we'll have 2,500. That's a 55% year-over-year growth on our number of units. Pretty incredible growth for a $500 million company.
And then one thing that is unique about our firm is we vertically integrate, which means we do all of the property management ourselves. So we are both the asset management layer and the property management layer. And I would estimate probably 80% of what you're going to hear tonight comes through our experience as property managers and the way we think about buildings in terms of marketing, leasing, maintenance, CapEx, all of those things. We think about that first through our property management lens, and that's pretty unheard of in the industry. Most groups our size really just focus on asset management, and then they vend out property management to third-party property managers. And we are vertically integrated through our sister company, Black Swan Living. We have a real estate sales team. We work on acquisitions and exits. We also represent homeowners and helping them with acquiring homes. And then we do a little bit of ground up construction. We've built a townhome community, an apartment building. We have a couple new apartment buildings going into the ground this year. We really enjoy ground up construction. It's just so fun to see something that is literally just dirt and then see something of real tangible value come out of that.
And just a little bit about us. We've got 15 years under our belt. I enjoy our marriage quite a bit, and here's to many more. Half a dozen kids. Elaine's a psychiatrist trained at the Mayo Clinic. I did a career in technology and had a couple of very successful tech startups. And we really love what we get a chance to do in real estate. We believe that what we do makes the world a better place to live, and that's why we love sharing how we do business. We think if you were to take everything that we teach you today and go buy your own apartment building and to do business the way we do business, that would make your world, the place where you live, the place where you'd buy that multifamily community, a better place to live. And it's something that we're incredibly passionate about that we get a chance to share with you here this evening.
So that's a little bit about us, and that's the history that we bring, that we've kind of filtered it down and tried to pack all of that experience into the time that we'll spend tonight for multifamily underwriting. Let's first teach kind of what is the traditional model. So maybe you're brand new to underwriting and you're asking the question, what is underwriting? What does that mean? Or maybe you've seen some other deals, you've done some yourself, or you've done some passive investing, or you've looked at passive investments. So let's first talk about kind of what the industry standard is. And we'll point out some of the ways why we don't do what's industry standard. Mm-hmm. And then we'll go into the way that we do underwriting and have all of those teaching points so that we can share with you what our method is. And then more importantly, why that's our method.
Yeah, some of this might seem kind of foreign to you, might have some jargon in it, and you are not crazy. The crazy ones are the people who live in this jargon, and it's almost like nails on a chalkboard to explain these concepts to you because they're, in our mind, they're so counterproductive. But in order to help people understand what you might hear if you're investing in like a different real estate syndication or private equity fund that uses these same underwriting techniques, we need to kind of explain this to you, and then also to help you understand why what we do is so different than the industry norm.
All right, so let's start with that explanation of the industry norm. Let's first start with the 5-year discounted cash flow analysis.
That's gold standard.
Yeah, that's like the most common thing that you might see in multifamily underwriting.
Yeah, so this is a simple formula that just instantly prints money. All you have to do is fire up an Excel spreadsheet. You buy this property. You look at an offering memorandum, which is just a brochure of what what a property is like and financial and physical characteristics about it. You project out 5 years from now that incomes will go up, expenses will go up. Then you assume that property is going to sell at, frankly, whatever price you think sounds great and makes your rate of return seem like the rate of return it needs to be. I have sat through countless boot camps helping people buy multifamily, and the teacher will say, well, just put in whatever assumptions you need to put in so that you get to a 15% IRR or a 17% total annualized rate of return. And we'll show you how trivial it is, how you need to tweak very small things in order to get to those outcomes. And you need to do absolutely nothing to actually improve the intrinsic value of the community. You just have to kind of fiddle around with a few rows in a spreadsheet. Almost every deal deck you've ever seen uses this technique.
So this is typically what happens in a 5-year discounted cash flow analysis. There's typically a projection for rent growth. 3% is a very common number, and that will just be projected out year over year over year. And it's been our experience, with 15 years of doing this, that's not how it works. Rents go up. Sometimes, unfortunately, they go down, even seasonally, right? Here in Minnesota, for example, our rents in the summer are much higher than our rents in the winter. So rents do not actually just miraculously go up by 3% every single year, year after year, but that's a very common assumption.
The gold standard.
The gold standard that's made. Pro formas show that expenses go up, but they always show that expenses go up slower than income. somehow in every scenario. And that's not necessarily been our experience either, particularly over the last several years with inflation and tariffs and interest rates and insurance and all of those things. But that's what you'll typically see is year one, rents going up by 3% per year, and then expenses going up. Because if they didn't show that expenses went up at least a little bit, it might really call into question what that analysis is. So they pencil in expenses going up, but the expenses always grow slower than the income. The exit cap, and we're going to explain to you what cap rate is. And so if you aren't sure what that is, fear not, we're going to get to that. By the time we're done with our time here together tonight, you will understand cap rate. You'll be able to explain it to a child. The exit cap rate in these analysis lands where the deal needs it to. And I don't believe that people in our industry are outright liars. I think it would be very hard to be in an industry if I believed that. I think what they experience is unbridled optimism. And we'll show you later this like tendency of like, oh, well, if I just change the cap rate from, 5.3% to 5.1%, like, ooh, everything changes. Now the
Deal's
works.
amazing.
Yeah, like, ooh, like I know I can do that. Like I'll figure out a way to make that happen. And that's not really how the future works. And then the sale happening on schedule. And I think that's a piece that it's just so easy to kind of not realize what it takes for a piece of multifamily real estate to transact. It is not like going to Costco and buying something off the shelf. It is not like having a lemonade stand and saying, we're selling lemonade today. For a piece of multifamily real estate to transact, it takes a friendly market with eager buyers that will pay the price that you need, with access to good financing exactly at the right time, and trying to land all of that sometime within oftentimes it's say like a 3-month window right around say loan maturity, right? It might be a 5-year hold period. The loan is going to mature at 5 years. It's written into the investing documents that say investors will get their return of capital and their return at 5 years. And for all of those things to just all come together in a very short window is pretty unlikely. To have a friendly market, eager buyers, good financing, all of it to happen in a short window. And yet these projections just make it seem like, well, of course that's going to happen. Like we'll just put a for sale sign in the yard. Buyers will come. They'll have access to financing. It will sell at the exit cap rate that we projected, and then everything will be great. Let's take a look at the actual numbers. So this is one of those times where I'm going to call you to your screen if you're listening more podcast style, so that you can see these actual numbers. And I just want to give like a word of peace to everyone. It's not as complicated as it seems. We're going to walk you through every single line. You will learn a ton. Even if as you're looking at this right now, you're like, whoa, that's a lot. We're going to get you through it. And you'll see that it's actually pretty simple. It's just income and then expenses. We're going to teach you NOI. We're going to teach you about cap rate. We're going to walk you through all of this. So just stick with it. Believe that it can be simple. Believe that we're going to teach you the things that you need, and then ask the questions in the chat if anything's coming up for you. But let's walk through this. Hopefully by now you're at the screen if you were listening podcast style.
So this is going to be a typical 5-10 year discounted cash flow analysis, and you can see there's some income and some expenses. So fiscal year 1, fiscal year 2, fiscal year 3. So if you bought this deal in August of 2026, fiscal year 1 would run between August of 2026 and August of 2027. And you're going to model out that you collect 1.312 million in gross potential rent. You discount concessions. There's no concessions whatsoever. Of course, no one's giving away free rent these days, right? And you discount a modest amount of vacancy loss, and maybe you have some bad debt, some people that don't pay their rent, but they're physically occupying the unit. And you add in some garage and parking income, some bill back, and you end up with effective gross income of 1.318 million in fiscal year 1. And then what happens in fiscal year 2? All of a sudden, your effective gross income, the total amount of money your apartment building collects, goes up to 1.4 million. And in fiscal year 3, it goes up to 1.5 million, and so on. Not because you've necessarily done anything to drive that, just an assumption that there's like 3% organic annual rent growth. And the expense line there, you can see you've got some marketing costs, some payroll, some insurance, and you can see that those also go up, but they go up slower than the income goes up. So your net operating income, that's your income minus your expenses, it starts out at $681,000 in year 1. And by the time you get to year 5, you're pushing $900,000 of net operating income, having done absolutely nothing. Just letting rents organically grow and controlling expenses. I'm doing some scare quotes here if you can't see my video. And
With only $25,000 of reserves,
yeah,
25,500, 25,500. The
for
500
specificity,
really,
yeah, because it's 500, they
exactly.
should have done 555, and that's
Yes.
how you would have known that you don't need a penny more. Elaine and I, we would easily have like $1 million of reserves on a deal like this, and just think about the ridiculousness of this for like just the idea that you would buy a business, any business, and somehow you would increase your income by like 30%, your profit on that business by 30% in 5 years by just running the business. It maybe tracks with the notion that you like buy a stock and the stock somehow passively appreciates or whatever, but this is not how multifamily works. And with how cap rates work, with the extraordinary multiple that you get in multifamily and the incredible leverage, the incredible debt leverage that you get, it's easy to turn that escalated NOI figure into the appearance of incredible profits.
The thing that I'll add, if even after that explanation, you're still looking at it, maybe feeling like, wow, this is a lot of numbers, those sorts of things. First of all, replay will come out and you can listen to it, slow it down, look at everything again. I tried to move the mouse around so that you could see where Nick was speaking to as he went through that. But the thing that I'll throw out just qualitatively is, does anyone know what life is going to look like in 5 years? Does anyone know what life is going to look like in 11 years? Does anyone really honestly know what life is going to look like in something as little as 3 years? Forget about AI and all of the changes and everything with that. In any given 4 year cycle, there's a new presidential administration. In any given 7 year cycle, interest rates go up and down, right? We know that any economic cycle is generally about 7 to 8 years. There's pandemics, there's changes, there's technology, all of the things that have happened over the last, say, 10, 20 years. And then the pace of change is accelerating now because of technology and because of AI. So you can just kind of look at that. And of course, you need to model out the future. We're going to show you how we do that. We're not saying don't model out the future and just assume that it's unknowable. You need to have some sense of it. But does anyone really know 3 years from now, or 5 years from now, or 8 years from now, to the dollar, $1,753,567?
Mm-hmm.
Like, can anyone really predict that? Absolutely not. There's no human on earth that can actually hit these targets. And so it's our belief that you need to have trends and be thinking about the behavior of your asset, your community, and then the broader market. And we'll get into that. But this is what a typical analysis will look like in multifamily underwriting. Let's talk about cap rate. That is like the number that everyone talks about.
Magic.
It's magic. In my coaching program, people will ask me like, what do you think about cap rate, or what cap rate should I use? And you'll know why after we finish this slide. But my answer to them is, I don't really care at all about cap rate. We don't really include it in our underwriting. I don't think at all about it in terms of an exit. It is the least interesting number to me. And when people hear that, if they've been in the multifamily space, they're like, what do you mean you don't care about cap rate? I'm like, well, let me explain to you why I don't care about cap rate. That's what we're going to teach you right now.
So cap rate is just taking the net operating income, the profit from that business, and dividing it by the purchase price. It's the opposite, or the inverse of a multiple. So if you sell a business, like say a restaurant, there's a restaurant right in front of us here, that might sell at like a 3x multiple of profit, of EBITDA. And an apartment building, it has an exceptional multiple, one of the best multiples in global capitalism today. That's why we're in that business, is because there's a huge lever. It's a 20x multiple, or approximately a 5% capitalization rate. So a 10x multiple would be a 10x cap rate. A 20x multiple is a 5% capitalization rate. So I'm saying this multiple times. Feel free to like pause this and rewind it. Talk to AI about what cap rate is, because it does, like, multiple makes way more sense to me than cap rate. But cap rate is the industry jargon term, and cap rate, in my opinion, is like a little more easy to misunderstand, and it's much easier to manipulate, accidentally or intentionally. And then there are different types of cap rates. Cap rates come in so many flavors. There's the going in cap rate. So based on the seller financials, what multiple of their profit will you pay? And those financials may be real or imagined. A seller could give you completely fraudulent financials, and there's really not much you can do to prevent that. You have to come up with your own budget, and your own budget will have a year one cap rate. So you take the seller's numbers and figure out what that cap rate is, and then you take your own numbers. Well, the seller's paying this much for trash. I'm pretty sure year one we'll pay this much for trash. That gives us the net operating income we might generate in year one, and it gives us the multiple that in our own estimation we're paying when we're running the asset. And then finally, and most critically, is the exit or reversion cap. So let's say that you buy an asset at a at a 10 cap or a 10x multiple of profit. And then in your model, you're like, well, we're going to make this asset so amazing, so beautiful, so glorious that when we sell it, we're going to sell it at a 5 cap instead of a 10 cap. So we're going to sell it at a 20x multiple on earnings instead of a 10x. Well, my friend, you've just doubled the value of that property just by wistfully assuming that you can sell it at a lower cap rate. And that's a very dramatic example to give you some easy math, but it's super common for people to buy an asset at a 7 cap and then just pencil into their model that it's going to sell at a 5 cap. Well, that's still a very dramatic swing in the valuation of that property at time of sale. And it's an easy thing to change, and all of a sudden your profit, your rate of return goes through the roof. So a little quip here. Sam models out exit caps. Sally asks, what will I actually do to make this property worth more? What things do I have control over to truly make this property more valuable to a future owner or myself?
Let's teach about how to calculate net operating income, or NOI. It's a really simple calculation. You add up all of your income minus all of your expenses. I made it just a little bit more sophisticated here to model what you'll typically see in a spreadsheet, where you will see what is called gross scheduled rent or gross potential rent. And then you subtract out vacancy and credit loss, which is residents who fail to pay their rent. Then you add in other income such as laundry, pet rent, internet storage, those sorts of things. And then you subtract out your operating expenses, taxes, insurance, payroll, management, repairs, utilities. But really you can think of it as add up all of your expenses, add up all of your income, subtract out all of your expenses, your operating expenses. We're going to talk a little bit about what it means to be below the line. And then you get your net operating income. And you'll see here how just $1 of operating income has a massive change on the value of an apartment building. And then I want you to just kind of put this little seed in your mind. We're going to come back to it a little bit later in the presentation. And that's the idea that things like debt, renovations, and one-time projects or one-time expenses are what are called below the line. They're what are called below the line. And I'm going to bite my tongue and wait to teach you guys about that. But this is so critical. This moves deals drastically. And there's no actual industry convention or standards for what goes above the line, which is what comes out of your expenses to calculate your net operating income, and what goes below the line, which does not impact your operating income on your spreadsheet. It does in real life, but not on your spreadsheet. There's no industry standard. It is completely at the discretion of the operator how they pencil in their spreadsheet, and that's going to be really important as we go a little bit along. So add up all of your income, subtract out all of your expenses. That's your net operating income. And at a 5 cap, remember a 5 cap is a 20x multiple. That's the number that we're going to use tonight because it's easy to remember. The math is easy. In reality, cap rate changes market to market. And by market to market, I mean like little town to little town. Like there is not like a cap rate for, say, Minnesota or Iowa. It changes, yes, block to block, month to month, and deal to deal. So there is no like industry standard normal cap rate. It changes all the time. But we're going to use a 5 cap, which is a 20x multiple in all of our math tonight to make it cognitively easier because it's a simple multiple. So at a 5 cap, every single dollar of additional annual NOI adds $20 to the building value. Every single dollar of NOI adds $20 to the building value. Let's keep going with this. Let's say we have a mid-sized apartment building, just 100 units, and we're talking about $25.
I remember then that was a big building for us. Now it's merely a mid-sized apartment.
Mid-sized, yeah. So let's say someone makes a spreadsheet and they say that rents for these 100 units is $1,000 per month. Someone else says rents for these units is $1,025 per month. Mm-hmm. And you see here how I don't think that this takes someone being like grossly dishonest or saying like, ooh, how can I cook up a fraudulent spreadsheet? I don't think that's what happens in the industry. I think people just get a little optimistic and they're like, oh, we'll figure out a way. We'll run a marketing promotion. We'll put a nicer faucet in. We'll change the lighting.
Like more rent comps.
Yeah, like we'll figure it out, right? So person A says the rents are $1,000 per month, and person B says the rents are $1,025 per month per unit. Mm-hmm. This is not a crash. This is not a recession. This is a rounding error that, in my opinion, happens day to day, right?
Two,
We
2% delta.
we lease units every single day. And we know, for example, that leases at the end of the month generally are a little bit lower than leases at the beginning of the month because you're trying to cure some vacancy, right? You're trying to get people to move in by the first of that next month so that you don't have another month of vacancy. So you bring down your rents a little bit, right? $15, $25. Winter is harder than summer. You name it. Like there's units that lease on the weekends tend to rent a little bit more than units during the week. Like it is very, very, very easy for an apartment unit to shift by $25 in monthly rent per unit. So what I would like for you guys to, oh, look at you guys. You're so ahead. I didn't even ask the question and I got some answers. I love it.
The people are reading the slides.
I love it that you guys are paying attention. That's so good. So in this situation, 100 units, $25 difference.
We got a lot of people in our webinar here tonight. Sometimes when we bring out charts, like we can watch the attendance go down in real time when we pull up a spreadsheet. So we're a little nervous doing this.
Yeah.
The people are loving it.
Yeah. So what I want everyone to know, if there's one thing you're going to learn tonight, I want this to be it. This is why we put this earlier in the presentation. How much value was miraculously invented by saying in this 100 unit apartment building, rents are going to be $1,025 per month per unit instead of $1,000. So let's do that math together. I see some numbers. I have a 30K, a 600K, 50,000 times 12, 50,000, 600K, 600K. Have some answers in the chat. So it's awesome that you guys are paying attention. Let's do the math together. That $25 tiny little shift could be the difference between a unit renting in the beginning of the month versus the end of the month in October versus, say, July. $25 times 100 units times 12 months in the year is $30,000 of annual NOI. And at a 5 cap, remember that's a 20x multiple, so that $30,000 of NOI at that 20x multiple miraculously changes the value of this building by $600,000. Mm-hmm. The largest asset in our portfolio, for example, is about $43 million. Even against a denominator of $43 million, 600 is a pretty big swing, right? Most multifamily real estate is more in like the tens of millions, right? 10 million, 20 million, 20, 30 million. So $600,000 just, it's either there or it's not. The value may exist or it may not exist is a big number against, really any denominator that you see in the industry. Let's say that someone is off by $50, right? Maybe they do their underwriting in the heat of the summer and they try their best, right? They go on to Zillow and apartments.com and maybe they even go and tour a couple of competitors, but it's the heat of the leasing season. And they're like, man, units are leasing for $1,100 a month. So they pencil in $1,100 in their pro forma. And then it turns out that was just the heat of the leasing season. The team can't actually sustain those rents all year long. And on average, maybe rents are $1,050. So they're off by $50 instead of $25. Take those same numbers. Now we have $50 times 100 units times 12 months. That would be $60,000 of annual net operating income. Multiply by that 20x multiple for a 5 cap. And now we're talking about $1.2 million of value that may be there or may not be there. My assertion to you is that there is no one in this industry, not us, not someone that's been in the industry for 30 years, 45 years. I don't care their door count. My assertion is there is no one that can truly predict rents to the nearest $25. Mm-hmm. And anyone who leads you to believe that they can predict something with that level of specificity, it's my opinion that they're either lying to themselves and they've convinced themselves that the spreadsheet math just miraculously works, or they are intentionally trying to mislead. I think it's probably more the former than the latter, but no one can predict something to the nearest $25 when we're talking about inventory that changes all year long across the days of the week. When it's raining out, it's harder to lease units. When the sun is shining, it's easier to lease units across the seasons. That's my soapbox. I'm gonna get off it because I think I've driven the point home.
We're gonna talk about a concept now that this is.
I hope your minds are blown.
Yeah.
Your mind should be blown. And $1.2 million can just come out of the sky.
And that $40 million asset that Elaine mentioned, a $50 rent delta would add $4 million of value to that particular asset.
Because it's 288 units.
Right. It would increase the value of the asset by 10%. That would get us like halfway to a cash out refi if rents go up by $50. So next, we're going to tell you about an advanced concept. If you don't
If you're
understand
able to look at the screen, this is a good time for it.
yeah, if you don't understand a single word that I say about this advanced concept, great. Just move on. I think it's critical to understand this advanced concept. We're going to talk about what's called a sensitivity analysis, and this is theoretically a safety mechanism that you use to check your fancy spreadsheet. And the way you do that, I'm going to really stifle an explicative here. The way you check your fancy spreadsheet, my friends, is to create a much fancier spreadsheet. It is the stupidest thing in all of multifamily underwriting. The boneheadedness that goes into the concept of a sensitivity analysis is difficult for me to articulate. Let's go to the next slide here for a second. So this is what a sensitivity analysis looks like. So on one axis, we have our exit cap rate, which we told you is made up. You just put in whatever number feels like a good number.
Let me just pause there for 1 second too, just to like really drive that point home. Because Nick gave the example, if someone says, okay, I buy at a 10 cap and then I sell at a 5 cap, like most people that have had any sort of multifamily underwriting experience would sort of see right through that. But look how much things change with really small numbers, right? So the smaller the cap rate, the more valuable the building, right? Because if something is a 10% cap rate, that's a 10x multiple. If something is a 5% cap rate, that's a 20x multiple. So smaller numbers are better if you're the seller. So let's say you can sell at an 8% cap rate, then your value is $2,187,000. Let's go down to just 7.5, not some crazy number, right? Just 7.5, a 0.5%. I don't think any of us would look at 0.5% on a spreadsheet and think, oh, that's a big number, right? Very small number. Now it's 2.3 million. So about $100,000, $150,000 spread, like what? That's like an 8% spread in value. Well, if you figure that the average multifamily building might have a down payment of say 25%, an 8% change in value is like a third of the original capital that was invested. And now I'm getting like a little, kind of mixed, and just bringing a lot of numbers together. But I just want you to see that very small changes in the cap rate have big changes in the value. And that's why we think that cap rate is just such a dangerous concept.
And we haven't yet explained this chart, because I think most people, okay, so this is what a sensitivity analysis is. So you have an X and a Y axis, and you've got different assumptions that you use to test your pro forma. So in this particular example, which is we just pulled this from a random, we didn't generate this, but we pulled this from a random underwriting that other groups do. On the y-axis there, we've got the exit cap rate, which remember is that magical made up number that we just say is whatever it needs to be for our rate of return to look good. And then on the x-axis, we have our percent of NOI target. So remember how our NOI over the course of 5 years magically went from 6.8 million to 9 million in that previous 5-year discounted cash flow analysis example. And we need to ask ourselves, well, how much can we really sell this thing for? What if we only achieve 90% of our NOI target? Or what if we do really well, we knock it out of the park, and we hit 130% of our NOI target, and that target, we end up at like 1.2 million in NOI instead of 9 million in NOI. And then you just plot this, and it's like a word cloud. It's like it just gives you some notion of the variance in potential values. But if you don't like the way the picture looks, all you need to do is make a slight tweak to it. Well, 70%, that's not possible. So let's look at a range of like 80% to 140%. And you'll even see like this is centered on 100% being like the default. Well, what if you shifted everything to the left? So you went from 60% to 120%. Well, you're going to get a radically different outcome from your sensitivity analysis, because you get to pick the ranges, right? And there is no industry standard for this sort of thing. It's truly whatever you make up. So the cure, the solution for complex spreadsheets that lie to you is to create even more complex spreadsheets that let you lie to yourself with even more confidence, with even more hubris. So if you didn't understand anything about sensitivity analysis, no big deal. We're going to move on. Just, people ask us all the time about sensitivity analysis, and we do perform sensitivity analyses, but mostly what we do is we just look at that 70% number on the left and the 8% number. We just look at like the worst case scenario. And is that something we can live with? And, is there upside potential? Great. Okay. Is it really critical that we quantify that? We're celebrating no matter what it is. Let's not focus on that. Let's focus on the downside first.
Speaking of downside.
Oh, there is so much
For
downside.
this story.
There is so much downside. So this is a real deal that we try to help people, we try to love people, and especially Elaine and I. Fortunately, we've never lost investor capital, we've never lost money on a real estate deal, we've never had a capital call, and so we've not had a front row seat to when things go bad. So anytime someone reaches out to us with a challenging situation, we try to help them. Maybe do like a consulting agreement or something like that, and we usually save them quite a bit of money, getting them out of a tough spot. And this is one of those situations. So on paper, this deal made a ton of sense, but in real life, not so much. A couple red flags that leapt out to us when we looked at this deal for about 60 seconds. We looked at the prior sale. This deal had sold a few years before the current owner had bought it for 40,000 a unit, and they paid $100,000 a unit just a few years later. And then the second, so I literally looked at prior sale, and then I just dropped a pin on Google Street View, and they were very confused by this. They're like, "But you haven't looked at the offering memorandum. You haven't looked at the finance." I'm like, "Nope. I just need to look at how much did the previous owner pay for it and when." And I dropped a pin on Street View, and I looked around, and I saw a liquor store and a pawn shop and a gun store and just a bunch of trimmings of an asset that might struggle with crime, with gangs, with drugs, with all the ills that can come with these types of assets. And they bought this property. They tried multiple different property managers. They hadn't really leaned into the management side of things. The idea is you're buying the asset, and it doesn't matter who manages the asset. You just find the manager that charges the least amount of fees, and that's going to give you the best financial outcome. There was no one who was like local to the deal that could go visit that deal, that could go eat breakfast in the parking lot and see how it felt. And no one really knew anything about this particular block. By dropping a Google Street View pin, I was able to see it was not a good block. Maybe the next block over was nicer, but this was not a good block. And so fast forward today, they are getting actively foreclosed on. They're going through the foreclosure process. And so we've referred them to some attorney contacts that we have, and doing everything that we can to make sure that they only lose all investor capital, because these Fannie Freddie loans, they're theoretically non-recourse, but there are carve-outs where if Fannie or Freddie believes that there's been significant negligence, where you really didn't do your homework or really mismanaged the asset, they can still come after you for a defaulted loan balance. And doing everything we can to help them stay out of that particular situation. So the numbers were never the problem here. The who, the where, and the how was the problem, and we see this over and over and over again when people reach out to us about deals that have gone bad. This is the formula we see over and over again.
All right.
Whew.
Here we go. What questions do you guys have? You're clearly paying attention because you guys were dropping numbers in the chat when that thing came up for NOI and value of building. Any questions that anyone has? Is cap rate important for refinancing?
Hell no.
I would say banks care about it less than we do. Even.
Yeah, the value of the asset, which cap rate kind of has an impact, but really it's the debt service coverage ratio. So how much net operating income does the asset produce, and how much debt can it support? So you're going to be your loan proceeds will be constrained by the value of the property, and your loan proceeds will be constrained by how much debt can it support. Typically, you are debt service constrained. Sometimes we drive up NOI so much on assets that they are LTV constrained, but that's pretty unusual. And typically, when you've driven up NOI that much, you can easily make a case to the appraiser that the asset should be worth more. In fact, the appraiser is often doing a back of the envelope check. Like if they go look at a loan that's an 80% LTV at 1.2 DSCR, like that's how they figure out what the LTV should be. That's just an old appraiser trick. So cap rate is a frankly irrelevant consideration for a cash out refi.
A question, someone said, how can you project cap rate that hasn't been proven by a sale? But I think that meant to have like an exclamation point at the end of it and not a question mark. Because truly, how can you project cap rate if you haven't, right? Because cap rate requires purchase price. It's part of the equation there. A question came in: what is the best way to find out what the cap rate should be for any given area? I'm curious what Nick has to say. I'll offer my perspective that I don't care. I am 0% interested in cap rate.
There are lots of resources out there, and you can look up cap rate. This is a little bit later in the slides here, but cap rate is a concept that is relevant to triple net commercial deals, single tenant national credit leases. So you can look up databases like CoStar that track cap rates, and you can see, oh, this market has a 6.723 average capitalization rate, but is that Class A, Class B, Class C? Is that a well-located asset? Is that a new construction asset? Those averages, in my opinion, tend to be pretty irrelevant and just so malleable, so conditional that looking at any average is very challenging. You'll look super sophisticated by saying, oh, there's a lot of cap rate compression in the marketplace, particularly in the Southwest on F-class assets. And that's just gibberish. It's just gibberish. It's just things you do when you're shooting the breeze with the broker. Just figure out what it's worth to you.
Here's how I might think about cap rate. Like we might, it is a known thing, for example, what say like the average height of say a woman is. Okay. What year is it, right? We know that humans have gotten taller over time in the last 100 years because of nutrition. Where was she born? What was her early nutrition? What is her ethnicity? We know that height varies across the world. Who's walking in the door, right? It can be two people born in the same year in the same place it can be sisters, right? To the same family with the same nutrition, and one of them's 5'5" and one of them's 5'8". Well, that's very different, right? That's how I think of cap rate, is like the average, not so useful, right? And it changes literally every single day. Something like a 100 unit Class A that's near economic centers that's, say less than 10 years old has a drastically different cap rate than say a 25 unit, even B class, not even dipping down into C class, B class unit that's maybe in like the suburban ring that hasn't been renovated in 25 years. One could be say a 3 cap and one could be an 8 cap. Like each characteristic of the building kind of changes the cap rate. And so I just find that it's pretty useless. But we're not just going to leave you hanging there, because then the next question is, well, what number do I use, right? Because if we just say, oh, we'll throw out cap rate, then you're like, well, what do I use? We're going to teach you about that here in just a little bit. We'll give you a number that we think is the most important number. How do you underwrite a deal when current rents are significantly below market rents?
You figure out how much you could rent it for, and then you underwrite to that number. Yep, and we'll dig into that here soon. How much do older buildings appreciate over 5 years? Is there an age that you won't consider buying? We will buy buildings of any age. We own many buildings that are 100 years old, and some of those are some of our best performing buildings. We love being able to, like, the privilege that goes with owning and operating those types of buildings. And we find the older buildings depreciate much less over 5 years than the newer buildings, which is another concept we'll speak to. It's very, very counterintuitive for most people. We'll speak to that here in just a little bit.
I'm going to take one more question and then we'll keep going with the presentation, but keep putting your questions in, right? We want to reward those of you that were able to make it live by answering your questions. Can we say the exit cap rate is only relevant when the deal's duration is only a few years, easier to advertise to investors? Interesting question. The longer you hold a deal, ironically, the more certainty you have, because then you tend to go more toward just like market and economic and macroeconomic norms. I would say that, even saying like, okay, well, is exit cap rate important if the deal's duration is only a few years? I would say no. And I think we have real data, right? It's 2026. Deals that people closed in 2023, right? Interest rates had started to go up, but no one knew that they would go up as far as they did or stay up as long as they have. What people projected for cap rate, what they thought cap rate would be in, say, 2026 versus what it is in reality is a world of difference, right? Remember that sensitivity analysis, just a couple point shift in cap rate totally changes all of the economics of a deal. So I don't think even like shortening the duration makes it a safer number.
Here's the craziest thing of all, y'all. There are so many crazy things we're going to talk about. Why are you looking at a reversion cap rate in order to advertise to your investors? Elaine, what is the SEC's stance on advertising rates of return for prospective investors for a deal?
That you shouldn't quote any like specific numbers and certainly not a guaranteed number.
Yeah. You should never tell your investor 15 IRR, 17 ARR. that is considered a worst practice by the SEC. You can point to your historical outcomes and then immediately disclaim, past performance is not necessarily indicative of future results. So, and I'm not trying to. That's like I'm not trying to be
We're not
overly
hating on you
feisty.
guys. We're
Yeah,
just hating on cap rate.
yeah, we're just hating on cap
Want
rate.
you guys to
Hate,
leave with the idea.
hate the game, not the player.
You don't have to believe it.
Yes.
But we want you to leave thinking, Nick and Elaine hate cap rate, and I'm at least going to remember that and maybe
Yes.
consider it in my future decisions.
Yes.
Let's leave
You'll
it there
notice
before we just beat cap rate to smithereens.
Okay.
Cap rate, we're like bullies, man. Okay.
Yeah.
All right, let's talk about some fun stuff.
Yeah. Act 3.
Yeah.
We're right on schedule.
Yeah, this is so good. Okay. Let's talk about the documents that you see when you are acquiring a multifamily building. This might be that you yourself are going out and trying to acquire something, or if you're a passive investor, remember that the operator, i.e. the people in Nick and I's shoes, this is what they're doing. So you want to have some sense of what they've done before they come to you and say, hey, do you want to invest in my deal? So here are the pieces of paper that are involved in a multifamily transaction. The first is the offering memorandum, the OM. If you call it OM, you sound hipper. Don't say offering memorandum, say OM.
Cool kids.
And that is the seller's marketing material. Remember that it should say offering marketing material. Instead, it says memorandum. That is marketing material. Remember that. The next is the T12 or the trailing 12. And that is the financials looking at the last 12 months. So if I gave you T12 for an apartment building, it would be let's say July of 2025 to July of 2026. I can't give you August yet because we're only halfway through. I'm going to put a little pin here too. Remember above and below the line, and that's going to be really important when we think about the T12. The T12 is the closest thing to the truth, but numbers can move all over that spreadsheet.
They can move. I like that.
They can in ways that are ethical, right? Because it is all subjective interpretation. There is no industry standard of what goes above the line, or there are some industry standards, but there are fewer industry standards than you might expect for what goes above or below the line. And then finally is the rent roll. So the rent roll is all of the humans that are living in that building today, plus any, say, signed leases that are coming up, say, between now and the end of the month. Who's living there, when they moved in, when they're moving out, what their rent is, what their security deposit is, and if they have any either credits where they've, say, prepaid some rent, or if they have anything past due. That's the rent roll. Guys, the rent roll changes every single day. People are moving in and out every single day. The rent roll certainly changes season to season, right? We have more vacancy in the summer, which seems counterintuitive because that's our leasing season. But in order for people to move in, people have to move out, right? So people move out, and then we clean up the unit a week or so later, new person moves in. So the rent roll, remember, is just a snapshot in time, and it changes very, very quickly. Remember, the offering memorandum is created by the broker, and the broker works for the seller. The broker works for the seller. You, as the buyer in multifamily, are typically represented by no one unless you hire a broker, and then usually you have to have an agreement that you pay that broker directly. But typically in multifamily, there's one broker, and they will become friendly with you, and they will make you feel as though they are representing you because they'll provide you with documentations, and they'll walk you through the analysis, and they'll answer questions that you have. And you might be fooled into thinking like, hey, this person is like friendly to me. You may not consciously have a thought of like, oh, they represent me, but I want you to be remembering that you can be friends, you can be buddy-buddy, you can enjoy these relationships, but you need to know that when you are talking to the broker, you are talking to the person who represents the opposing party. They are paid to tell you the most optimistic thing. Mm-hmm. They're not liars. They're not bad people. I want to keep saying that.
We love our brokers.
We're being pretty harsh tonight, but they are paid to say, yeah, of course you can get $1,100 per month. The last 2 leases, we were able to get $1,100 per month. Maybe you can in July when the sun is shining and the days are long and the community is moving about. But can you get $1,100 November 15th, right before the holidays when it's dark and rainy? Right? So they're going to tell you the most optimistic information. Remember, buyer beware. Let's have some fun, and let's look at an actual offering memorandum. So if you're able to look at your screen here, this would be a great time to do that. This is the actual offering memorandum from something that we closed on in the Secure Freedom Fund at the end of December 2025. So this is Villages at Essex Park.
Very high quality offering memorandum from a very high quality brokerage and broker. You'll see some offering memorandums that are, there's less to them, fewer pages, but this is a $40 million deal. So they certainly, put in the time to give you all the information that you would potentially need to know to purchase this community.
Psychologically, it feels as though the offering memorandum is truth. So let's look at it. We don't have time to go,
Yeah.
every single
Yeah.
page by
So
page, but let's spend a little time together, right? We've got this beautiful picture here of the pool, right? The lawn is, perfectly green. Everything looks nice. There's our table of contents there. Village is at Essex Park, a 288 unit community located in a thriving medical economy. Doesn't that sound so fancy?
I'm so glad we own this thing. This
Nothing
looks like a really nice investment.
Yeah, it tells you all. Oh, look at that. Robust market dynamics and attractive going in yield. So,
Yield is a jargon word for cap rate, so to speak.
so some of the investment highlights are there. Beautiful pictures, right? Shows the beautiful Mayo Clinic, right? And don't get me wrong, guys, we use these exact same types of pictures in our marketing materials, right? You want to, if you're going on a dating profile, you put up your prettiest picture, right? Like, of course, it's the prettiest pictures of the community. Gives a little information there, how many units, the occupancy, the average in-place rents, tells you about the unit count, 1, 2, 3 bedrooms, some more pictures. You want to speak to what you're seeing here?
Yep.
Talks about constrained apartment inventory in Rochester. So showing recently completed apartment communities that are in, it says a 5-mile radius. So it's
not a ton of them.
So it's starting to go from like, hey, this is the specific community, and now it's starting to move out a little bit.
And I'd love to skip down to where we look at like a broker pro forma just as an example. So there's lots of great background.
So talking about Mayo, amenities, the apartment market, strong investor returns.
Absolutely.
Should we speak to this one? This one's pretty fun.
I'm the one who's trying to stay on time, but we should speak to this. When we were walking the property with the broker, Elaine was just casually observing, because I usually give you like a book, when you're walking with them as reference. She's like, "Oh, Georgetown, that's a really nice community nearby. I think we own that one. Don't we own that one, Nick?" And
I didn't say it like that.
And Residence Discovery, that's RDS. Oh yeah, we own that one too. And Dakota, oh yeah, we bought that one in 2022, right, Nick? And we're half of the comps in their comp set, which is to say that we're market experts, and we are able to pick out what are and are not reasonable comparable sales.
And we offered on Maven and ultimately chose not to buy that one. We chose not to like be aggressive in our offer on that one. We offered on Crystal Bay, and we offered on Civic Square.
So sad Crystal Bay got away.
Yes. Oh, it'll come back. We'll get it.
One of our investors was with us, who's on the call. It was with on that one. I wish we would have gotten that one.
Yep. The only one of these 7 that we either didn't own or hadn't offered on was Song Hill 41.
Yeah, it was internal sale.
All right, so here we are. Here is the rent roll, right? So remember what I told you about rent roll. It tells you the square footage, the market rent, the price per square foot, and how many of them there are, right? So this would be like like the unit mix, right? Like a 2-bedroom, 2-bath, a 1-bedroom, 1-bath, a studio. This particular community is a little more complicated because there's some income restrictions. So we're not really going to speak to that like 60% AMI that you see. Just kind of ignore that. That's irrelevant for what we're teaching tonight.
It's so convenient that they've done all of the rent roll analysis for us, though. We probably shouldn't even bother doing our own analysis.
It must be that the rent is $1,482.
Yeah, let's just pencil that into our pro forma, which they've conveniently just done for us as well. How about that?
Here we are.
So this is a broker pro forma. And again, we love our brokers. We do a lot of business with brokers. They're all great people. And the broker pro forma is never like a lie. It's just an optimistic look at what financials could be. And so you can see there's some columns here, trailing 12, trailing 6, trailing 3, trailing 1. And then a projected year 1 pro forma. And man, year 1 is always so much better than last year. The grass is always greener. So you can see that on a T12, we go from effective gross income of 4.468 to $4.9 million in year 1. Gross scheduled rent goes from, you can see where Elaine's highlighting gross scheduled rent goes from 4.67 million to 4.9 million. We noticed a huge discrepancy between scheduled rent and collected rent, which means there's an awful lot of people who are on the rent roll with rent they ought to be paying, and that rent is not showing up in the bank for some reason. Wonder why that is. That's just a little gap there. No big deal. You can even see that like the gross potential income, it only goes from 0.93 million to 5.12 million, and yet there's an effective gross income swing of $500,000 or over 400,000
Mm-hmm.
because they start collecting the rent. They eliminate a lot of quote unquote bad debt or slow paid rent. And so you go all the way down to net operating income, and you can see they're projecting you go from 2.3 million of NOI to 2.6 million of net operating income. Funny thing is though, like our pro forma actually is not that different from their pro forma, and a lot of our business plan for this property was truly just to cure that bad debt. But this paints it in such a
Like it's just so easy. You just
dispassionate.
have to
We'll
close
just start
and
collecting rent from people.
yeah, just
Right, they're already in the units. Just start collecting rent from them. No big deal.
change your loss to lease from 425,000 to 185,000. It's easy.
Yeah. Yep. So
Just bring that patient back from the ICU.
yep, they have their
No problem.
assumptions, which are very transparently disclosed. They typically do some analysis on like your taxes and insurance, which is super. So here's your 5-year discounted cash flow analysis, and you can see your gross potential rent. It ticks up by your gold standard 3% per year, and your effective gross income ticks up by the same amounts, and your expenses, they go up too with all the same assumptions. And then your net operating income, my friends, it goes from 2.6 million to 3.34 million. Absolutely staggering climb, and all you had to do was just buy the property. That's it. And it's all of a sudden your income is so much higher. And we're going to say for like the 15th time here, we love our brokers. There's nothing wrong or unethical with anything here. It's just optimistic assumptions, just optimistic projections. And you have to do your own pro forma. You have to do your own underwriting. You have to create your own spreadsheet. You can't use someone else's calculator, and you certainly can't rely upon what you see in the brochure.
I think the brochure, the only use of the brochure, in my opinion, is looking at the pictures. Because in general, pictures can't lie. I mean, they can have good photographers and photograph the best units and that
They
sort of
lie a
thing.
lot more than they used to.
Yeah, with AI and optimization and stuff like that, you have to do all the numbers yourself. That's something that will come up. I'll be coaching someone and I'll say, well, what number did you use for say trash? Oh, the number from the offering memorandum. I'm like, oh no, 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 no. You have to call the trash company and
Mhm.
explain to them, this is a 100 unit building. Kind of what your unit mix is so that they know approximately how many humans are living in those units, right? That's going to correlate to how often they need to come and pick up those dumpsters. And then what is the total all in after all the county fees and taxes and all of those things? Because the base number in trash is usually like half of what the actual number is by the time all the taxes and fees are clicked on. Like you have to call and you have to do every single number yourself. The offering memorandum is only good
Yep.
for the pictures, in my opinion.
I'll say one last time, Essex is going great, and actually our pro forma, like our outcomes, are lining up pretty well with the broker pro forma. We hate cap rate, and we want to make sure no one just trusts the OM blindly, but we also want to make sure that everyone knows like there's lots of great people out there in the business here.
Yeah, so just remember the offering memorandum is a marketing document, and
Yeah, that's
remember
it.
the psychology, right?
Yep.
That is a marketing document. It is optimism compounding line by line. I think that really captures it as like I don't think we've seen like maybe one or two just like bold faced lies in offering memorandums ever, right? And they were like complicated enough that they probably were just true errors, but they had big changes in terms of the financials of
The
those.
error is always in the seller's favor. I'll tell you that. I've never once seen an OM that has an error in the buyer's favor.
But what it is it's we can get an extra 25 on rent, and we won't have as much loss to lease, and we won't have as much vacancy, and we won't have as much bad debt, and expenses will be contained, and it's just optimism over and over and over again. And then remember, every dollar of NOI in a 5 cap market is $20 of value. So just a couple dollars here and there of increased income and decreased expenses, and it really starts to compound. And anything can look favorable if you just change a couple dollars here and there. So let's talk about the ways that
I love our Simple Sam quote there. So Simple Sam is always eager to deep dive on the OM. Sally has noticed that the best deals have no brochure. Elaine actually laughed out loud when she.
So no joke, like half an hour ago as I was finalizing our slides and making sure the fonts all looked right and everything, my office is right next door to Nick's. And I just started laughing, like cackling. And he's like, "What are you laughing about?" And I read this line to him. Sally has noticed that the best deals have no brochure. I think that's really true. When I think of
Glad
like,
you liked my joke.
I thought it was really good. Um, they're local deals is what we call them,
Mhm.
right? They're local deals, local sellers. It's often like the seller calling you directly, and maybe like an attorney or something is involved. But there's no big marketing pitch. It's just seller to buyer, and no brochure. So let's talk about 10 things that you really need to think about in underwriting. These are the 10, let's say, like most risky things that if you don't critically think about these in your underwriting, you can really get bit.
And these are things that you can spot when you're looking at a deal as a passive investor. These are just easy things. The first one, biggest one, is property taxes. So property taxes are based on the value of the asset. When the value transacts, that value is often disclosed to the local government, who then reassesses, and your taxes can go up. And they can go up a whole lot. It could be that that asset is assessed at, half of your transaction price, which means that your taxes are on track to double. And those doubling taxes could kind of cripple your future underwriting outlook. So just that's a real easy one. What are the trailing 12 taxes that the seller has paid? What taxes have they paid recently, and what are taxes going to be in the future? And this is where you really do need to go to the assessor's site. You need to call the assessor. You need to truly understand the taxes there. They are a huge item.
You just call the county assessor, and you don't even have to disclose the address or
Yeah.
anything like that. You just say, hey, I'm thinking about acquiring something, and I see that it's currently assessed for 5 million. My purchase price might be around, say, 7 million. What will my taxes be after I close? Some municipalities, it's like a straight jump, like in 1 year. Some of them latch right onto the purchase price. Others, they do like a graduated escalation, and they come up with their own internal valuation. They don't use the purchase price. So you don't know until you call. But it's pretty safe to say that if you acquire at a higher price than what the county currently has it assessed at, that your property taxes are going to go up.
Next one is insurance. This is a huge, huge, huge item. The insurance that's on the T12 may be incorrect. Might be an error on the T12 insurance payments, and it's probably an error in the seller's favor. And you might just write down that trailing 12 insurance payment and assume that that's what you're getting in the future. So we have some assets where we pay as much as $1,000 per unit per year in insurance. And we have other assets where we pay as little as $100 per unit per year in insurance, a 10-fold difference in per unit per year insurance costs, 10x difference. So you have to have some idea of what that's going to look like. And the way you do that is you go get real quotes from your insurance provider. Debt. So this is one that actually got us. When you assume HUD loans, they have MIP on them. There's different fee loads that go with different debt instruments. There's different things that get escrowed. You need to make sure you're accounting for the cost of the time value of money on those escrows. Just putting those numbers into an amortization calculator is reckless. Like, you can do that as like a placeholder, as like a sanity check, but you need to get an actual estimate. What is my mortgage statement supposed to be like? Payroll. So we've bought lots of assets that are lightly staffed. They're low touch assets where the seller claims that there's very little payroll needed. Just no one ever leaves. There's never a maintenance ticket. Nothing ever needs to be replaced. And so our labor cost is super duper low on this asset. You need to figure out what it's actually going to take to staff that site with people that you pay, whatever your wages are that you need to pay your site staff. Market rents are hilarious, absolutely hilarious, because you can pencil in, whatever you want for market rent on a rent roll. I'm going to say that again. When you look at the rent roll, there's the actual rent the tenant pays. Maybe it's $1,000 a month, and you say, here's our market rent, and that rent could be, say, $1,100. It's just an extra $100 for no reason at all. Just you have a belief that whenever that tenant eventually moves out, that you're going to rent that unit for $100 more, and that's an easy one to catch. Just look for deltas between market rents and actual rents.
Share the story about the utilities.
So there's an asset which we offered on a long time ago, and
About 5 years ago.
Yeah, about 5 years ago. Yeah, exactly 5 years ago. And uh, so this is just an example of one of the many, many, many very sneaky things that a seller can do to market an asset for sale. So what they did was they made all of their units all bills paid, and these are townhomes, so the utility bills are massive. And then they took all of the payments to cover people's utility bills and moved those to non-recurring expenses below the line, because these were
That below
one-time
phrase. There it is.
one-time marketing expenses that would not recur. Well, if you paid a utility bill last month and you got a 1 year lease or 2 year lease on that unit,
Sneaky, sneaky.
I have a feeling those expenses are going to recur. And if you had to do all bills paid on that unit the last time you leased it, I mean, you might need to do all bills paid the next time. And if you don't, then you're probably going to have to reduce the market rate. And
Or
these
have a lot of vacancy,
and,
right? As
and
those
these people
people
had the
move out.
courage to then say the market rate was actually higher than the in-place rate. So it was all bills paid. It was not clearly disclosed that these were all bills paid. When we figured out that it was all bills paid, the simple, just matter of fact explanation was, well, yeah, that was just a temporary, leasing concession, a leasing incentive. And then the market rate was actually higher than that. I mean, this is something that will swing the value of an asset millions and millions and millions of dollars, and it did in this case. So a few more,
Five more. We're
few more of
halfway
the
there, guys.
the 10 deadly sins of underwriting from the offering memorandum alone. You can buy a community that's like run down. It needs new roofs and new siding, and all the units need renovation. And brokers will position that because that's their job, right? Is to position this in the most favorable light possible and say, well, look at the limitless upside potential on this asset. Limitless
Meat on the bone.
meat on the bone. Meat on the bone. That's right. You could make this asset so much more valuable, which means that you should pay a lot more money today.
It's not this way in the market right now because the market has shifted a lot. But in like 2021, 2022, when the market was really, really, really hot, we would tour an apartment building, and let's say it was like 100 units. Like 25 of the units would still be classic, which means maybe they had never been renovated. And then like another 25 might have like white cabinets and quartz countertops and maybe like a certain fixture in the bathroom, those sorts of things. That was when like group two owned it. But they didn't renovate all the units because they wanted to sell it with meat on the bone. And then another, say, 25 units would have, a different renovation style, a different renovation style. We called them Franken buildings. And we were just so horrified thinking about, that physical structure just changing ownership all the time and haphazard renovations and a lot of like lipstick on a pig, like painting bathtubs and painting countertops and stuff like that. It looks good for a couple of weeks, right? It certainly can get you through a sale, but it starts chipping and looks horrible, like literally just a year later. But that was the name of the game then. Like you would never fully renovate a building because then you couldn't sell it with upside. You had to say there's meat on the bone. Again, it's not quite like that in the market right now. And then we'd be driving home from those and we're like, could you imagine living in that community? Right? The ownership group changes every couple of years, the management changes every couple of years. You like literally don't know who's like manning the store. Right. And there's just different contractors coming in and out all the time, half renovating units and stuff like, that was another soapbox. I'll get off of it.
Another one here is utilities. So we spend a crazy amount of time deep diving on utilities, requesting utility bills from the seller, from the broker, from the utility companies themselves. There's huge upside in utilities. We walked one property today where there is a very high trash bill there. And when we're walking the building, we're not like, hey, do we like the units? We're looking for operational efficiency opportunities. So this particular property has 8 underground parking garages. And inside of each parking garage, I think, are 6 dumpsters. I'm not getting those counts quite right. And we know from experience that if we can build optimally placed trash corrals that can accommodate, dumpsters that are several times larger, we can get a much better price on trash, which allows us to pencil in a much lower trash number in our pro forma. All we have to do is go erect some really classy looking garbage corrals, get them out of the dumpster, get them out of the garages so that they're not stinking up the garages where people park their cars, and save a ton of money on utilities. But the worst thing you can do is just put the T12 utilities in there. It's a huge mistake because utility costs usually go up over time. We model out ways we can save money, but you have to model out the utility costs go up. Another one is other incomes. You look at fees, laundry, pet rent, all these things. Well, just because the seller had a bunch of pets on their rent roll doesn't mean that you're going to have a bunch of pets on your rent roll. Vacancy is another one. So, 5% is like a gold standard for vacancy. Well, much of our portfolio runs like a 2% vacancy rate, but we've noticed that our income restricted properties, they can run up to like a 7% vacancy rate because it takes so long to do a lot of the government paperwork that it instigates significant additional vacancy. And then we've talked a little bit about below the line.
Just keep that in mind. We're going to show you on the actual numbers. That is cap rate's like the most important thing for you to learn, that it's a really dangerous number. And then below the line is the second most dangerous thing we're going to teach you tonight.
One of the most dangerous things about this whole process is that it's so easy. All you need to do is go have lunch or coffee with some real estate brokers in your area. They'd love to take you out for drinks or go to a game of golf. They're awesome to talk to. They're very flattering. And I love hanging out with brokers, and I love hanging out with bankers. They too are always eager to buy us a steak dinner. There's one week where I went to Ruth's Chris 3 times, like no exaggeration, because there's just such a long line of people that want to give us, the fanciest dinner they can or fanciest lunch they can. And they know if they just endear us, have some reciprocity, then we might buy a property from them. All you need to do is talk to a broker, go on a tour, get an OM, a T12 rent roll, send it to a lender. That lender's going to write you a loan. The broker gets paid when you close, when you buy. The lender gets paid when you close, when you buy. And they are incentivized for a transaction to happen. They are not incentivized for you to get a good deal. Does not make them bad people. Just be aware of their incentives. So here's Sam and Sally here. Sam gets to an LOI by Sunday night. Sally asks one question: who's going to run it?
All right, so this is how we underwrite. Operations first, spreadsheets second. That is the opposite of the industry. Almost everyone else in the industry leads with the spreadsheet, and then the operations is just like, oh, I'll hire ABC Property Management. They'll take care of it. And if they don't take care of it, I'll fire them and hire a different one. We think that is completely backwards. We say operations are everything. We have a whole podcast episode about it as well. So
we're on Act 4, the final act.
The final act
of our digital underwriting masterclass.
Here we go. So the 5 questions that you need to understand when you were thinking about a multifamily community. Let's start first with the one that people obsess over. They obsess over the wrong one. And that is the what. The flyer, the OM, the unit count, the pretty pictures, the seller's numbers, the seller's pro forma. That's what people tend to focus on. The when, where you sit in the cycle, what are interest rates doing, what is the debt cycle doing? And even like it's interesting to me that, when I started doing real estate 15 years ago, the thing that was most important in my calculus was like the street, right? Like the street, the houses on it, all of that. And now it's almost like I have to be this kind of like quasi expert in global macroeconomics because debt is so important, right? And just small swings in interest rate, which are influenced by things that are completely outside of our control, right? The interest rate does not care what's happening in Rochester, Minnesota, and whether or not it's a nice street. It cares what's happening, all the way across the world by decision makers that are completely unrelated to real estate. So thinking about where you are in the economic cycle and more importantly, in the debt cycle. How exactly will you add value? Mm-hmm. Something that you can actually go to a crew, to a construction crew, or to a management crew and say, can you do these renovations? How long will it take and what will it cost? Go to a manager and say, can you implement this management plan? What do you think about it? Where, which market, which block, which side of the street, hyper-local matters. Hyper-local matters. I can think of so many examples off the top of my head where someone, comes to us with a deal that's gone sideways and they'll say, well, they comped it to, XYZ property. And it's just like 3 or 4 blocks away, right? So when they're like maybe looking at a Google
down the street,
like a Google map or something, like they're like, well, it was just 3 or 4 blocks away. Like how many 100-unit apartment buildings are there in a community? Like, of course we had to look at one that was say 3 or 4 blocks away as the comp. But then when you poke around on Google Street View, or better yet, you go there, or better yet, you live there, right? So it's not like you're getting on a plane and you're having to, do all this work just to go there. You live there and you're like, hey, let me go drive that block. Or better yet, you just know that block because you've already driven it many, many, many times. And you know that a couple of blocks is a world of difference, right? Maybe there's way more traffic and noise on one block. The other might back up to a park, like school boundaries change, you name it. Where is really critically important, like very, very, very hyper local. And then finally, the who operates it, who manages it, who is handling the emergencies at 2 a.m. That is the most important question. Mm-hmm. That, in our opinion, is the most important question. Operations is everything. So here we have Sam and Sally again. Sam starts with the model, and Sally asks her property manager what they would do. Because the property manager is the one that's going to show up day in and day out, speak with the residents, do the leasing, handle the maintenance, handle the emergencies. What would the property manager do? That's what Sally's most interested in.
So this is a critical point here. A deal must have an edge, or it is a mistake. An edge would be your asymmetric advantage.
Yeah, we did a whole real estate real life on asymmetric advantage a couple years ago.
There's really only 3 kinds of advantages you can have. This is pretty much it. Either you see something that other people do not, and maybe you have a particularly sharp eye. Like we saw the dumpsters inside of the parking garages today. I would wager that 75% of other people touring that asset did not see that. You could do something that others cannot. People ask why we spend so much time building a property management company, hiring these people. We do in-house lawn, in-house snow, all these things. And it's not just to keep costs low, it's because it gives us a strategic advantage, a comparative advantage, of an asymmetric advantage. And now there's so many things we can do that other people cannot do. And then finally, the market is inefficient where you are in your particular local market. And this is probably the most likely advantage that you have. If you're buying in an area that requires hyper local knowledge, you know that that one spot is the good spot or the bad spot, that block is the good block. That's one of the best, like most accessible advantages that people can have because real estate is truly hyper local. And if you don't walk into that deal and know, here are the 5 things that I know give me an edge, an advantage on this deal, buying that deal is almost certainly a mistake. Here's a little slide on how being hyper local is ridiculously favorable. So like there's a deal I walked today. I walked 3 deals today that we would potentially buy that we'll offer on. And it is one of those deals is very large. The deal is actually in 2 different zip codes. 2 different zip codes.
Well, that's interesting.
That is interesting. Talk about hyper local. If you are local, let's say you're buying a small multifamily property, and all these principles apply to say an 8-plex or a 12-plex or something like that. If you know the contractors, if you can handle emergency on call, if you're like an owner operator, that is your local advantage. And again, if you can't name your unfair advantage, you don't have one. You probably shouldn't be buying the deal. Here's Sam and Sally. Sam has an institutional grade model. His model got even fancier, therefore better. Sally's lived on the block her whole life.
Absolutely. You have to know what your asset feels like, smells like, sounds like. You have to know it, right? Like many of you on the call are physicians, right? What do? You go see the patient, right? You can do as much chart analysis, get collateral from family members, review the labs, all the things. You have to go lay eyes on the patient. It is the exact same thing in real estate. And you have to see it in the morning, at noon, and at night. When are people leaving? Where are they going to? What are the economic drivers around there? In the afternoon, what's the sound of it like? What's the state of the dumpsters? That's when like there's sort of like peak chaos in a lot of communities. What's the foot traffic like? And then at night, you have to be there at night. You have to know, what do you hear? Who's in the lot? How do you feel? Do you feel safe? The offering memorandum, the OM, can never tell you those things. Rachel has some pictures she's going to share. Nick and Rachel went to one of our property, or a potential property, a couple of years ago. And Rachel went with Nick, and they went and looked at these buildings at like 1 in the morning.
Yeah.
1 in the morning.
Yep. Got off the plane, or the plane landed like midnight, and we went straight to the properties. Yep.
Yeah. So Rachel has some pictures she's going to try to share in the chat here. We didn't have time to get them into the spreadsheet, or I'm sorry, into the PowerPoint here. And if they don't work here in the chat, we'll put them in the replay email as well. But that's what it takes, right? You have to know the property, just like you have to know your patient. It's the exact same thing. So Sam does a deep market analysis. Sally eats lunch in the parking lot every day for a few weeks.
I ate lunch in the parking lot of an apartment building today. Practice what I preach. The broker called me a couple hours later and was like, "Nick, what are you doing in the parking lot of that deal?" Apparently, the seller noticed I was there and wanted to know we have legal right to be there, but they're not accustomed to buyers eating lunch in the parking lot, and we are.
When I was in the office today, Nick was out in the field, and the very first thing I said is, "Oh my God, your shoes are so dirty." And he's like, "Yeah, I walked 3 apartment buildings today."
Here is what I've got like 20,000 steps in for the day. Here are my filthy shoes from walking.
You can't see it, but they're literally just covered in dirt.
Yeah.
It is our position that if you are looking at your underwriting and you cannot think of a way to add value, do not buy.
Mm-hmm.
Do not buy. Walk away from something that's what's called a yield play. So we're going to give 2 actual stories where when we looked at everything, the offering memorandum, did the tour, talked to the brokers, did our own numbers, met with the existing property managers, scoped it out, had lunch in the parking lot, all of those things. There were 2 deals that we walked away from. One is the books were just too good. This was a stabilized deal. We actually had a lot of rapport with the seller. They're a local family, really just had a lot of like similar interests with them. And we just kind of kept going back to it, kept going back to it. We just couldn't figure out how their numbers were so good, and ultimately decided that we felt like there was a healthy dose of optimism in those numbers, and we walked away for that reason. And then the second is one that we toured at Real Estate Real Life, our in-person event a couple of years ago. And this was a property where our own analysis revealed that we felt like we could not manage it as well as the existing management. At that time, our management company handled maybe about 1,300 units. It was being managed by a very well-run, large national firm. We just weren't at the operational level that we
Yeah.
felt like they were. And we felt like if we acquired that community, that our rents would go down, our vacancy would go up, our expenses would go up. And it takes like a lot of surrender of ego, right? To say like, especially in an industry where most of the time we can manage things better than our competitors because we're local, because we're vertically integrated. So it takes a lot of surrender of ego to say, in that particular situation, we're not the right owner for this. We're not big enough. We're not experienced enough at this point. So we're going to pass and, continue to build our operational excellence and our teams and everything. And maybe at some point in the future, we would be the right owner. But I want to make sure you know that saying no is the end goal. Saying yes is not the end goal. When you say no in real estate, in anything in business, that's when you make and protect money. A pass is a successful underwrite. So let's say you go through this and you've called the county assessor and you've called the trash company and you have an insurance quote and you've put in a tremendous amount of work into your underwriting, and then you say no. It can feel like, man, like what a waste of time, or that wasn't successful. And I'm offering to you that that is the success. If you cannot add value, do not buy. And being disciplined to know when to say no is half of the magic. So Sam and Sally here. Sam loves to buy yield plays where no hard work is needed. And Sally always wants to know how she can create value with hard work.
So the next thing to dig into here is income. So we've talked a lot about expenses. There's more lines for expenses, but income is one of the areas where it's easiest to lie to yourself. And you have to be really careful when you're doing underwriting. Here's a few examples. So we do a bulk internet program. We have this very aggressively negotiated win-win deal with Metronet Internet here in Rochester. We pay $30 or $35 per month. And we charge $65 per month, which is still less than the $90 to $100 per month a tenant would typically pay for that retail fiber internet, fiber direct to their unit with a dedicated router. So we make $30 in profit per unit per month. We can project out that we can retrofit that internet, and we do some research in advance. Does Metronet have a fiber backbone in the area? How many years are they away from it? What's their rollout cost? What sort of contract do we need to sign? So we don't just pencil it in. We do some deep research, but we're able to bump rents by $30 net. And remember how that one building went up by $600,000 in value with a $25 rent bump. So you can see what a big deal that is. When we look at rents, we actually will literally discard any rent data that we have from the seller. We literally just throw that data away. And then we talk to our leasing agents. We show them the property. We might tour the property with our actual leasing agents. We show them photos. We show them the area. We say, what can you rent this for? What can you rent this for? And then we compare that to the seller. We don't just take the seller's rents, assume we can achieve them, or bump those rents up by 3% per year. And then we can even do some test marketing or shop the property with some of our existing tenant contacts and just say, hey, if we bought this property, what would you think? Would you want to live here? And we very quickly get market feedback sometimes from those sources. And that's recon that you can really only do when you own the property management company, which is why we own the property management company. On the expense side, we look at water-saving toilets, water-saving shower heads, faucet aerators. We have smart valves in place for the water main. We spend a lot of time on water. It's one of the best ways we save millions, tens of millions of gallons of water per year. We put in a plan for how we can conserve gas. We manipulate thermostat settings. We change how things are managed seasonally. We refresh boilers and do tune-ups and put in cutout controls. We do motion sensor switches. We literally interview each light switch. I mean, this is kind of silly, but we will touch buildings and we will talk to them, and we'll say, just like, how are you doing? What do you need? And like this light switch in this laundry room, does this need to be here? Could we put a motion sensor switch? Could we get rid of the switch altogether? And we make sure that there's an owner for every line item on that budget once we own the property. We call that process Overwatch.
There's a
Sam and
whole person on our staff, and her entire job is just Overwatch. She is
yeah,
our Overwatch captain.
yeah. So Sam doesn't worry about appliance replacements since they're a non-recurring expense, and those expenses go below the line. When Sally hears appliances are getting replaced, she talks to the technician and asks how to fix them. That's expense control right there. So you've seen the huge impact that these swings can have when we look at net operating income and cap rate. So again, $1 per unit per month is $240 of value at a 5 cap. That $30 internet becomes $7,200 of value per unit per each individual unit. We've rolled out internet to at least 500 units in the last quarter. So what's 500 times 7,200 if someone wants to put that in chat? How much value have we created just with our internet rollout alone in the last quarter? And you can see what a multiplicative impact that has. So we've been able to push rents with renovations and other improvements to the community. In some cases, going from $938 per month to $1,700 per month, which is massive improvements made to that community. So in-place cap rates,
there are times when they're useful.
There are times when
it's not multifamily real estate.
It's yeah. If you're buying a CVS, Walgreens, if you're buying a big box store that has a national credit single tenant, it's a fantastic metric, the gold standard for metrics, and it is completely and utterly misapplied when it comes to multifamily. We've already beat up on cap rate a lot though. So let's make sure that your pro forma isn't fantasy by just checking with your operator. And if you don't have an operator, then or if you don't know how to operate an apartment building yet, you have a little bit of a conundrum, and you really need to have an operator. You have to have some knowledge of operations in order to be able to have a pro forma. If your manager will not put their name on the budget, you have an answer about the deal. It's truly that simple. So before we buy a deal, we go to our team. We show them the budget. We say, can we do this? And we encourage them to challenge us, because when we don't make that budget, we're gonna be upset that our team has failed to deliver on that budget. They own it.
So let's show the math. One of the questions that came up a little while ago is, do we have our own spreadsheet? Absolutely, we do. And we're going to get to that. We're going to do a walkthrough live tonight. And then you're also going to get access to the exact spreadsheet so that you can take it for your own deals, to analyze other passive deals. We want you to have that spreadsheet in hand. So let's say you are looking at an OM, and you ask the broker what the whisper price is. That's the word that you say, right? Because it's not just like splashed on the OM the way it would be, say, in like single family housing, where there's just like a price that's displayed. So you say, what's the whisper price? And they say, well, the seller would like to get, say, 10 million. And you do your math and you come up with about a 6 million purchase price. That's what you can justify when you look at your rent comps, your loss to lease, your vacancy, your expenses, your net operating income. You think you can pay 6 million. Asking price and offer price are often millions apart, particularly today. Say several years ago, if the asking price was 10 million, that building might have sold for, say, 12 or 13 million with multiple rounds of what's called highest and best. Today, it's not really like that. What's called the bid ask spread, which is how much they're asking for and how much you're willing to pay, is very, very, very wide. So how do you do that? How do you say, I'd like to make an offer on this at 6 million, even though you're asking 10 million? You do not want to be known as a low baller. That is a fast way to lose friendships, lose relationships, lose rapport, right? At the same time, you cannot pay more than the building is worth. And in general, you want to honor the time that the broker put into you doing the tours and getting you the data, and the time that you put into yourself in running all of this analysis. So you show your work. You say, here is my spreadsheet. Here are my numbers. This is what I'm coming up with for rent. This is what I'm coming up with for expenses. I called the county tax assessor. I called the trash company. I called the utility provider. Here's my number. And remember that this is not a hobby. It takes many, many, many repetitions of doing this to hone in the spreadsheet, to hone in knowing what's a deal qualitatively, right? Not just quantitatively, but qualitatively to build these reputations. We haven't talked anything here about, say, debt. That's a whole other masterclass that we can do of once you come up with the amount that you're able to pay, well, then the next thing you do is you got to go find debt, right? And get the bank on board.
We should throw a link into chat if we can of our debt masterclass that we did last year.
Yeah. It is very, very, very easy to lose money in multifamily. Let me say that again. It is very, very, very easy to lose money in multifamily because the numbers are just so big, right? If we're talking about they ask 10 million, your math says 6, but you just get sort of swept away in the multiple offer process when they keep asking for highest and best, and they flatter you through it of like, oh, you made it to the third round and you have to submit more information. You have to submit, information about like your financials or your management plan. So you feel like, oh, I have even more hours in this. Like, oh, maybe I can like eke it out, right? You look at cap rate, you look at some other things. You're like, oh, I think maybe I could pay 8 million. You really never should have paid more than 6. Mm-hmm. Right? It's very easy to lose money in multifamily in this example. So Sam is eager to get in the game. And Sally wonders why you would ever play a game you can't win. Sally has a good head on her shoulders. The easiest person to lie to is yourself, right? The psychology of you've spent hours and hours and hours in this spreadsheet. You've toured it twice. You're excited about the pictures. You want it. You want the ego and the excitement. You've taught yourself to believe in it. There's a bidding process. And so you eke up a little bit at a time, right? They don't just come at you and say, 6 million, no way, 8 million or else, right? They're like, well, just to even get into best and final, you need to be at least at like 6.25. Like if you can get 6.25, I can get you into best and final. And then you do that. And then another week passes and they're like, well, we have 5 offers in hand and you're the only one that's south of 7 million. There's all this like broker speak, right? Like, so you got to get north of 7 million and you're like, oh, maybe I can find another $25 of rent, right? Go back to what we taught in the beginning. You know what that $25 does to the numbers, right? So you're like, okay, well, there's $500,000 of value right there. Like, okay, I'm at 6.25. Like, I need to get north of 7 million. Like, oh, man, I bet I could get rents up $40, or maybe I can get $25 in the rent and then save $25 in the expenses. So now I have a $50 spread. And before you know it, you've way overpaid. That is what you don't want to do. Sam finds the $25 and wins the bidding war and wins the ego war. And Sally closes the file and says, no, thank you. It's interesting, we've been in this game long enough now that the deals that we said no to 5 years ago are coming back around. Mm-hmm. And we have the original OM and we have all of our original underwriting and all of our notes and all of our pictures. And we know what it transacted for and we know what we were willing to pay. There's one, you say the numbers because you probably know them better than me, but the one that just came around, what did we offer at the time? What did it close for? And then what are we going to offer today?
I don't remember the exact numbers, but we offered in the like mid 20 millions on it, and it ultimately transacted at 32 million.
This is the one where all bills were paid.
Yeah. And I think we'd probably offer in a similar or a little bit lower range today, maybe 24 million today, because things have improved financially at the asset. However, interest rates have doubled since then. So that's just where the numbers fall in, which would probably constitute a complete loss of capital for that seller. But they're also in the same spot where they're probably contemplating having to put millions of dollars into the asset just to avoid foreclosure, which is a situation that a huge number of operators are in right now. Yep.
All right, I'm gonna skip the part about Class A, Class B, Class C. We wanted to include it tonight, but I really want to get to our underwriting calculator. So if we have time, we'll maybe circle back to that. But I really want to get to the calculator because that's really the most important part. So let's go into how we do underwriting. We've talked about kind of what the industry standard is, why we do things so differently, the psychology behind why we do things so differently. We've talked about operations and everything, Sam and Sally, and now let's see what our actual underwriting calculator looks like, and not just what it looks like, but how we interact with it.
Rachel, you can throw a link into chat with that calculator link. We're just gonna pull that up on screen right now as well. So we deliberately did not share this right away because we know people are just going to be kind of fiddling around with the calculator because it's fun. It's fun interactive exercise. Well, now's your chance, and feel free to to pepper us with questions. And this is a real deal that we've de-identified, but these are the real numbers from that deal. If you want to challenge some of our assumptions or something like that, you are more than welcome to. And we encourage you to come up with your own template, right? Don't just use our calculator. And you'll see that our calculator is very, very simple. It is not very complex. And we've got just a few sections here. So there's a few columns here. So column B, seller T12, column C, at closing. Sometimes we have a broker pro forma column in there. It looks like there may have been a few hidden columns. I don't even know what I have in there. We should probably figure out what those are. We have some basic income buckets. So gross potential rents, that is what you'd probably get from the rent roll, or as a gross potential rent in the seller T12. Vacancy. So the seller had a 2% vacancy on their T12. Well done, seller. They had operated it very efficiently. We're going to go ahead and put 5% vacancy. Our historical portfolio-wide vacancy right now is like 2.2% for this area for Rochester. We're still going to put 5% vacancy into our model. Bad debt, $6,000. Now, we, generally speaking, our bad debt runs 0.01, 0.02, 0.03%. A rounding error. So we have 0 for bad debt. I would not necessarily recommend that for most operators. We have some pretty exceptional systems that avert bad debt. We also don't offer concessions on any of our properties, which is also pretty unusual and may not be an appropriate assumption for you. This is our calculator, not yours. So please don't pencil in our Zillow quote on our apartment building when you have a very different apartment building, a different market. Parking income. So that's included in the rent roll. You have to be careful about this, right? Because they give you this T12 and Claude, or just your own, when you're kind of glossing over these numbers, or in the broker pro forma, there could be an error, and you could very easily double count parking income, or overestimate like the number of parking spaces. On 2 different times we've bought apartment buildings where I overestimated the number of parking spaces through some easily facilitated mathematical errors. So we'll say. And then other income. So the seller had $15,000 of historic other income in the last 12 months. We typically average about $500 per unit per year in other income. So those are going to be late fees, early termination fees, just kind of random, recovery from security deposit, damages. So the seller's number is going to be very different from our number there. So you can see our at closing numbers are going to be just the seller's rent roll, and we come up with total operating income, or effective gross income. The seller had $744,000. We're at $753,000. So the income picture doesn't change very much, which makes sense. And then our next column over there, 1 to 3 years later, and we're just going to hang with the income section for just a second. When we say 1 to 3 years later, or sometimes I just will
in the future.
Yeah, at some point in the future. This is not a 5-year discounted cash flow analysis. Rents do not magically go up by 3%.
And it takes time to move rents, right? Because you're legally obligated to honor all of the leases. So you can't just come in and say, oh, leases are this amount now. You have to allow those leases to turn over.
Yep. So we sat down with our leasing agents and we just asked them, what can you actually lease this thing for? Fortunately, we own thousands of units in this area, and we have a very good idea of what we can rent things for. And we know that there's 6 alcove units, 21 bed units. And if you just click on that cell F2, you'll just see an incredibly simple formula there. So there's 21 bed units that we rent at $1,500 a month times 12 months rent. So you can see this is like a very almost childishly simple formula and spreadsheet compared to some of the really fancy looking spreadsheets we've shown you. We find that it is much harder to lie to yourself with a simple spreadsheet than a complex spreadsheet, and you're much less likely to make mistakes. We've got some garage spots there. I think we actually assumed that the garage parking income went down versus the seller amount. We have a property service fee in there that we charge. We have Wi-Fi. We're going to implement our Wi-Fi business plan. We, on average, in our portfolio, about half the units have pets, have 1 pet. So, half the unit count, we've got a pet at $60 per pet per month, which gives us our gross potential rent. We deduct our 5% vacancy, and then we add in our $22,000 of miscellaneous income. And this gives us $928,000 of effective gross income, or total operating income. This is a huge leap. This is a massive increase from the in-place rent roll. This is not a safe assumption, y'all. You should not assume that you can just magically outperform in-place leasing. In this case, we've done this many, many, many times before, and this is probably a conservative assumption. We feel extremely confident in our ability to do this. A big portion of that delta is also the Wi-Fi. So 34,000 of that delta is just the Wi-Fi alone. So for us, this is a safe assumption. For most people, this is not a safe assumption. Feel free to go ahead.
What indicators do you use to forecast rent growth other than historical rent growth?
There is no rent growth in this model. I'm going to say that again. There is no rent growth in this model. No 3%, no 1%, no 5%. It's going to take several years for us to get to the rents that we know we can achieve today. So just because it's 3 years in the future does not mean that there's 9% rent growth, 3 years times 3%. There's always loss to lease. There's always what we know we could get for that if it was a new marketed unit today, but someone already signed a lease a year ago or 2 years ago at a lower rent. We're escalating to catch up. And we tend to do very deliberately, I'll call them modest rent increases, typically less than 10%. If someone's way behind, if someone's 30-40% below market, we'll still only bump them 10% a year because frankly, we think that's the right thing to do. We think that's the ethical thing to do. And so it could take us 5 years to get to today's market rent. So we have no rent growth penciled into this model.
You can think of these numbers here that I just highlighted in F, the income here. You can think of that like if we received this as a brand new construction empty building, this is what we think we could rent it for. But there's people living in it, so it's going to take 1 to 3 years to get there because of lease turnover, right? You buy a building and then next month some of the leases expire and you can bump those up, but some of those leases likely have 12 full months on them, right? So you can't do anything to that lease for that 12-month period. But that's how you can kind of think of what we do here. But it takes time to get there, right? So in, say, 3 years when we get there, what we predicted for, say, our one beds, maybe it's now, say, like 380,000 because of organic rent growth, but we don't pencil that in at all. Does that make sense? Hopefully that clarification there makes sense. Good question.
Excellent question. Excellent question. Thank you. Feel free to keep peppering chats with questions. We're just kind of blasting through. So looking at some of these expense items. So advertising, we got a quote from Zillow, and then we'll just have a website for this. So we know what that marketing budget's going to be. If we look at, say, our alarm expense, there's no individual breakout for that item from the seller financials, but we know what it takes to maintain an alarm system. Taxes are going to go down because we are paying less than the assessed value on this property. We're getting a very good deal on this property, paying probably 30% below replacement costs and less than the assessed value. So we actually can very confidently model taxes going down.
And that's rare in the market right now, guys, right? Keep in mind that typically you're paying more than the seller paid the last time it transacted. Right now, because there's so much uncertainty in multifamily, you might be paying less. But in general, I want you thinking that taxes are generally going to go up.
Yep. We model out internet's going to go from 13 to or 12,000 per year to 18,000 per year because we're going to roll out our internet upgrades. But then we model out that payroll is going to get cut in half because we have our in-house management company and we can charge frankly below market cost to the assets that we manage, and we don't have to mark up that payroll. You can see our lawn and snow costs. We model it goes from 16,000 to 7,000, and even that's probably conservative. It's possible we might be able to do this for like 4,000 again because that in-house lawn and snow. So overall, we're modeling out that expenses decline pretty significantly from 373,000 to 286,000 year one, and then go back up to 300,000. 1 to 3 years later. And overall NOI, we're going from 371,000 to 629,000. We're projecting out that we almost double NOI, which is going to be a ludicrous, thing to model out for most people. This is not normal. This is not normal to project out that you're going to double NOI in just a few years. But for us, this is probably a conservative scenario because everything we're doing we've done all these things before countless times, and so we can do it with a high degree of certainty. We model out just a little bit of debt just using a simple amortization calculator. Let's assume we get a 6% rate, 30-year AM, and a $5.4 million loan amount. We've got interest-only payments there for the first few years when we first close on it. And maybe we get 2 or 3 years of IO, and then it flips to a 30-year amortization. We typically get like a 5-year fixed rate debt instrument on this. We pencil in 3% organic appreciation, which in my opinion is a relatively safe thing to do, but some might argue you need to do like a reversion cap rate analysis or something like that. For me, this 3% assumption for appreciation is something my brain can understand, but we don't typically look too much at that. We're looking more at cash flow and our cash on cash rate of return. So we buy this thing for $7.25 million. We're going to put down like $1.875 million. We're going to spend about 1% of that purchase on closing costs. And again, that's a very conservative assumption. We should spend less than that. This is a brand new Class A asset, so we penciled in 40 grand for renovations to roll out a fitness center, a couple things, but this thing it needs very very little. Overall, this gives us a 7% cash on cash rate of return in year one, and it should get to a 12% cash on cash rate of return in the first 1 to 3 years. And that's basically what we need to achieve for this to work for Secure Freedom Fund. We have to have a crystal clear conservative path to get to a 10% cash on cash rate of return, so we can pay our investors, so we can pay that pretty hefty return that we pay, the 10% plus fixed rate of return in Secure Freedom Fund. And then we don't have cap rate on here anywhere. Incredible, right? We do model out a debt service coverage ratio, though, because that's something that lenders look at. That was a question that someone had earlier, is how do you model out for lenders? And lenders love to see that you're modeling out debt service cover. The lender does not care so much about what the cap rate is. They care, can you pay your mortgage? And your debt service cover ratio, they want to see at least a 1.2. So if a lender looks at this and sees a 1.44 debt service coverage ratio in year one and a 1.6 debt service coverage ratio in year 1 to 3, year 2 or 3, they're going to be very happy about that. They're going to feel very good about that deal. So we went through that pretty quickly, but not that like this is a very simple pro forma.
And all of the formulas are all included here, right? So if you're like, I don't know what debt service coverage ratio is, it's F37 divided by F38. So let's go find that, right? F37 is NOI divided by debt service, right? Yep. So how many times can you pay your debt service with your net operating income? If your debt service is 100,000 and your NOI is 300,000, 3, right? It's just a simple ratio there. The bank wants to know that you have at least 1.2. 1.2 is the number you want to hit for your DSCR. I would say the two most important numbers to us are DSCR, because that tells you how much lending you can get on it, and that helps you to determine, essentially, you're kind of baculating into what you can offer on it, and price per unit. Price per unit is the number that we consider the most. A question came in, what does a good downside case really look like? Is it simply lower rents and higher expenses? Can you bottle multiple stresses at the same time? Yes. So this is what we do. So this is a simple example, and we have the notes here, but we would just copy this, go over and paste it, and then we might say like bad macroeconomics, right? Or like interest rates don't go down, or, just modeling out, whatever, right? And then we would come up here and say, maybe we can't get 97,000. We can only get, right here, it's 6 units at 1,350 times 12. Well, what if we can only get 1,200, right? We might ask our leasing agents, like, what is the lowest rent we've had on any alcoves in the last 5 years?
Yep.
Right. So let's pull the actual data from the actual portfolio and put that in there. You may not have a portfolio that you can compare it to, so you'll need to hunt a little more, or you'll need to ask a property manager, right? Like, what's the worst case scenario you've seen over the last, say, 5 years or 10 years? Or you just model things down, right? Like, what if there's a 10% rent decrease, and then you can model that. And then it's also fun that you copy it and you say, like, what would a home run look like? Don't get too carried away with this, right? Just do this and then, like, close your laptop and go to bed, and don't get too excited about it. But it can be fun of, like, what if everything went well? What if we could just, like, all the rents were a little bit higher than we expected, and fees were a little bit higher, and expenses were a little bit lower. You can really start to see, like, that's what, like, a grand slam would look like. Not because you think, like, oh yeah, I'm just going to get a grand slam. Like, I'm God's gift to real estate. I'm just going to get a grand slam. But it's fun to see, like, this is the furthest potential that this deal could have over the next several years. So it's kind of like that sensitivity analysis, right? But instead of looking at percentage of NOI and cap rate and using that to create the sensitivity analysis, we look at actual human scenarios, right? Like, what if it's the pandemic? What if rents go way down because AI takes all the jobs and people have universal basic income? What if expenses go way up and they continue to go up because we've seen, unprecedented inflation over the last several years, and, like, that forest fire really hasn't stopped yet. It's kind of tamped down a little bit. What if there's tariffs? Like, we model, like, real things that we've seen. What if there's stagflation? So it becomes a hybrid of a qualitative approach and a quantitative approach, instead of just that sensitivity analysis that looked at NOI and cap rate. Nowhere on here is cap rate. It's modeling out the behavior, right? Same as in medicine, it's like, well, what if I gave a higher dose of this medicine? Or what if the patient's vitals changed this way? Or what if this lab value changed this way? That's what you model off of, right? That's how you're predicting that patient's future. I think it's the same thing in multifamily is you think about what the story could be, and then you model off of that.
Mm-hmm.
Like, what if Rochester doubles in population, and then as a result of that, there's higher rent, and you can have like 50 different stories here, right? You just cut and paste them, and then we just have the notes here, and then the reality is somewhere in the middle. So that's where like a sensitivity analysis is useful because no one can actually predict the future. But if you predict enough different futures, the reality is probably going to be like the average of all of those, right? You're going to get some wins and you're going to get punched in the face some of the time. Like that's just the truth of the matter. That's business. But can you see how it's totally different than a sensitivity analysis that looks at cap rate and NOI? Good question there that came in.
Yeah, and here's your chance to ask questions. There's some questions that came in. Can you expand that window just a little bit there?
I sure can.
Let's see. If walking the property at all hours is important, then would you only invest in a syndication if you can physically walk the property? So, me personally, yeah, I would only invest in a syndication where I could walk the property, but I'm also probably overly finicky about those sorts of things. Now, so you might say, well, how can we walk properties with Secure Freedom Fund? And
Come to real estate, real life.
we practice what we preach, y'all. We get you a bus. We do not make money on this conference. We lose money on this conference. And you get on a bus and you come see the assets. And we have investors who have come out. They're contemplating seven plus figure investments, and they'll come out on a plane and walk around with one of our leasing agents and just like look at our properties. And we encourage them to do so. A plane ticket is not expensive. Your time may be expensive, but it's an educational thing, and it's an educational thing that will pay future dividends, right? Like you probably don't necessarily need to walk every property that operator is sponsoring that you're investing in, but you should probably walk at least one of them if you're thinking about making a big investment. And Rachel could probably, yeah, there you go, realestatereallife2026.com. We've still got a few seats available. I think we've sold 77% of our tickets for Real Estate Real Life, so we still have some tickets available here. Let's see. It's awesome to pay 10% to investors in Secure Freedom Fund. I agree. I think it's awesome. The owner of a business always comes out on top. How do you make money while paying your investors?
I feel like the owner of a business gets punched in the face all the time.
Leaders eat last, my friend.
I got punched in the face multiple times.
Leaders eat last.
Property management questions. But the question there is a wonderful one, which is how do we make money while paying our investors? We have a webinar about Secure Freedom Fund on Friday, so I invite all of you to that. I want to keep tonight like no pitch, right? That's what we said, that this is an educational thing, but I will answer that question. If the properties return more than that 10% that we pay out to the investors, any of that additional upside comes to us as general partners. Pretty simple there. Jeff asked, curious how you would factor into the offer price if the seller is willing to contribute to financing through a partial seller contribution. Really good question. For probably like 2 years, that was kind of like our main playbook. Mm-hmm. So talk a little bit about that.
That's a common arrangement in commercial real estate, and it depends on the market cycle and different situations. In general, the price always goes up. There's almost always a premium price paid if there's any level of seller carryback financing, contract for deed, anything of that nature. That's just a known thing, to the point where when the city assessor appraises your property and they note that there is seller financing or contract for deed, they will typically discount that sale price. Same with an appraiser that does like a third-party appraisal on the property.
It's set in business that you can either get price or terms. Mm-hmm. So maybe you want to pay $4.5 million, seller wants $5 million, and you're like, okay, well, I can pay $5 million, but you need to carry, say, $1 million or $1.5 million of that at a very favorable interest rate for 10 years with a balloon payment, right? So you get your terms, they get their price, and then you can make a deal.
Yep.
So that's something we did for many years when the market was really, really hot. We couldn't necessarily compete on price because when we ran the numbers, we're like, this is the max that we can offer, but we can be flexible on terms. So that's what we did there.
Great question.
Do you order third-party appraisal and inspection reports? How reliable are those reports? Yes, absolutely. The rare times that maybe you're doing a loan assumption, you don't need an appraisal. But if you're getting a traditional mortgage, whether that's a single family home or a multi-$100 million apartment community, there will be an appraisal because that's the only way that the bank will lend on it. And we take what the appraiser says very, very, very seriously. A typical appraiser looks at that community. They pull all sorts of interesting comp data, and they have even more data, right? Like we only have our portfolio to compare to, right? They have data from the entire market. And then they typically do a three-pronged analysis. So they look at cap rate, which we're not as interested in. They look at price per unit, and then they look at what's called replacement cost, which is if someone needed to just build that building brand new today, how much would it cost? And so we learn a lot from our appraisals. And the real value of the appraisal doesn't necessarily come from that transaction. It comes from the next transaction, right? Because the appraiser is kind of always getting like a snapshot in time of the market. And then you use that to then kind of toggle up and down the next time you're putting in an offer. And then inspection reports, yes. So we take a licensed inspector, we take our plumbers, our electricians, roofers, people who look at the sewer lines, whole team, walk every single unit, every single common area, every single boiler room. It is always the case, guys. It is always the case that the unit that you just like miraculously can't get into are the worst units, right? Like sometimes the property manager knows that and they're like purposely trying to steer you away from it. And sometimes it's just that like that tenant is like cantankerous and the property manager doesn't want to bother with them. And you're like, nope. I have to see every single unit. There's been many times where we'll say like, okay, we have 6 units, like we'll be back tomorrow or we'll be back next week or so like, leave no stone unturned. That is your time to negotiate repairs, walk away if you need to, right? If you find out something during that due diligence period that fundamentally changes the deal for you, walk away, right? Surrender your ego and walk away.
And those reports are reliable and they're things to look at, but they are not perfect. And we buy a lot of units, and this is going to sound a little crazy, but I personally walk almost every single one of those units. Like there's you're walking down a hallway, and it's like a scale boy. So I've got like 4 people with me and like 2 people from the property management team that's selling, and they're all going into units, taking detailed notes, scoring things. And I will literally walk into each unit as we're going through. If a team member sees something that I need to personally look at, I'll go into that unit and, take photos and videos and, document things. Like it's easy to just say, okay, an appraiser did an appraisal. That appraiser probably looked at just a few units out of, hundreds of units. My time is really valuable and I take my time very seriously. I'm ruthless with my time. I walk every unit, every garage, every boiler room, every mechanical room. I get on the roof. It is important to go to the Gemba, the place of real work, the place of action, the place where value is created, and understand what you're buying. So you should absolutely take those reports seriously, but they are not to be depended upon.
Yep, absolutely. What about the property you lived in as a kid before? Curious if you also walked the property that you lived there before. Yes, because Nick lived there
Late 90s.
Yeah, like a long time ago. So even though he knew it very well, and we actually knew it, not necessarily because Nick had lived there, because that was 20 plus years ago. Our kids play soccer like literally in the backyard of that community, and so we're there at that community a couple nights a week for years, just kind of watching the traffic come and go, watching the operations happening. We're still there. I mean, I was just there this morning. My son had soccer practice this morning, and I was there looking at the building. So yes, we walked that one as well. That was a big one. That was 288 units. So we took a team of, I don't know, maybe 25 people or something.
Yeah. Huge team over many days to kind of crawl through everything in that property.
Yep, absolutely. Good questions, guys.
Yeah.
So you will get the calculator. I hope what you're seeing is that the calculator is really simple, right? Like keep it simple. Be simple, Sally. Income minus expenses. That's true for any business, a lemonade stand, a restaurant, a hair salon, a medical practice, multifamily real estate. The thing about multifamily real estate that's different is the multiple. The multiple is so high, right? In a restaurant, it might be like a 2 or 3x multiple. In real estate, it might be 18, 20, even 15, right? That's still a huge multiple. But everything that you need to think about what is the story? What are the operations? Who's going to actually get these outcomes? Who is going to actually lease these units, right? If we think we're going to get $1,100 a month for a unit, who is actually going to do that? who is actually going to manage the maintenance, the lawn, who's going to handle the utilities, all of those things. So keep it simple. Think about the story. Qualitative is more important than quantitative. Know that the numbers don't lie. We want you to know your numbers, but specificity is not accuracy. And our preference is to have a simple underwriting model and then model out many different scenarios over and over and over. You saw when I just cut and pasted it right there on that sample, that pro forma, and you know that the truth is somewhere in there, and you're going to have some wins and you're going to get punched in the face some of the time. And the longer you hold, the more security you have, right? So have debt that allows you to hold for a long time horizon so that you can enjoy when the wind is at your back and the rents pick up and the market kind of carries you. That's something that typically happens in real estate. Now I'm getting, kind of into like the philosophy of real estate investing, but those are the things that we think about. We don't think about cap rate. We don't think about that sophisticated sensitivity analysis, and never, ever, ever trade. Never think that specificity is accuracy. It's just simply not true. And it will psychologically fool you. If anything, a model that's like, well, we might get, say, around 1,000, right? In the winter, we might get 975, but in the heat of the summer, we might get 1050. On average, we might get, say, 1,000 per unit, right? Like that's where you save yourself in multifamily. Couple things in terms of like what next steps could be for you tonight when you think about multifamily underwriting and what you're going to do with this skill set.
Yeah, so we've got you can be an operator, and we hope that you understand that this is a serious responsibility. This is a privilege. It's cool to be an operator. We think it's cool to be an operator anyway. We think operations are everything. Or alternatively, if you don't want to run an apartment building, you can be a partner, and you want to meet syndicators and fund managers that align with the way you want to do business. We've got some links there to Investing 101 and 201 if you want to learn some more about what that
That's
looks
where
like.
Simple Sally, Sophisticated Sam and Simple Sally, that's when they had their debut.
Yep.
Was Investing 101.
And this is what we've always done. So we joke that we like to give away the cookbooks. That's these master classes. We give away our whole playbook of how we do business because we think the way we do business makes the world a better place. And if other people did it that way, if we got put out of business with our own playbook, fantastic. But also, if you read the cookbook and say, man, that sounds delicious, but I just want to eat. Well, we've got the restaurant, and that's Secure Freedom Fund. That's our private equity fund. So Sophisticated Sam, he wants to run the deal. He wants to get these GP fees. Sally realizes this is a job, and she needs to find a partner. She can find someone who can run that deal, is excited about running that deal. So if you're interested in the restaurant, if you've loved this 2-hour cookbook, when we were getting ready for this webinar, I said I think this will be the best multifamily underwriting webinar like available for free in the country this year, and I think we've delivered on that here. We have a webinar coming up for Secure Freedom Fund this Friday, October 14th at 12 p.m. Central. This Friday, October 14th at 12 p.m. Central. You can go to securefreedomfund.com if you want to put your name on the wait list. This is not a high pressure pitch. We don't have much to sell you here, but if you do like door number 2, we would love to open the restaurant to you. That rhymed. That was pretty good.
There you go. Yeah. There you go. In that webinar, we'll walk you through the Secure Freedom Fund, our targeted returns, tax implications, how you can join the wait list. When we open the Secure Freedom Fund, it tends to move pretty quickly. So what we like to do is put out that education early, give you a chance to review everything, share out with you the actual PPM and operating agreement. You have time to talk to the people who are important in your life, share it with your attorney, your CPA, whoever helps you make those investing decisions, so that when we do open the wait list, we tend to fill anywhere from, say, minutes to days. It moves pretty quickly, but you've had plenty of time to do all of your due diligence in a comfortable time horizon, and then you're ready to go when we open. So that's what that webinar is on Friday, August 14th, just a couple of days now at noon Central. It has been a blast being with you guys tonight, talking all about multifamily underwriting. We hope that you've learned some things. We hope that you take that calculator and just tinker with it, right? You can you can use that calculator for a single family home. You can use that calculator for an apartment community that has hundreds of units. You can add things pretty easily, but think about keeping it simple, modeling out many, many, many different scenarios. Know that the truth is somewhere in the middle there. Investing 101 and Investing 201 are from our YouTube channel. Those would be great things to check out next if you've never checked those out. That's where we first introduced Sophisticated Sam and Simple Sally and walk through kind of what a passive investment is, what some of the terminology is, what's typical in the market, how we do things differently. You can use that to continue to advance your investing education. We also have that debt class that we did about a year ago. That's on our YouTube channel. If you haven't checked out our YouTube channel, highly, highly, highly recommend it. Just hop over to YouTube, search for Black Swan Real Estate. We have stuff there going back many, many, many years. We've done these community power hours for many years across a wide range of topics. We're excited to bring them back with multifamily underwriting. We're going to keep going with state of the market and doing some other things. So if there's something that you particularly would love for us to teach about, when you get the replay email, just reply. Tell us what you're interested in. That lands right in my inbox, and maybe we'll create a masterclass around that particular topic. I think we answered all of the questions kind of as we
believe
went.
we did.
I'm just going to take a look at my questions here and.
Oh, there was one.
Go ahead.
Yeah, for lending purposes, which financials would you submit? Your own model or ones from the OM? That is a more complex question than it might seem. You almost certainly need to have yet a different pro forma that you submit to the lender, but not for the reason that it might seem, because the lender has their own guidelines on certain things. So just as an example, they might say in their underwriting template, in the lender's underwriting template, that repair and maintenance expense must always be at least $500 per unit per year, and they might include lawn and snow in their repair and maintenance budget, which is a very common practice in the industry. We don't like that. We like to see it as a separate expense. We see grounds as being different from repair and maintenance. Well, if we have that separate breakout for lawn and snow, and then our repair and maintenance budget is below that threshold, the lender will then bump up the repair and maintenance expense to their minimum threshold, but still leave the lawn and snow as a separate line item. And you can be, kind of penalized if you don't understand how that lender is underwriting the deal. You are almost certainly going to be eligible for much lower quality debt. So we could spend a long time talking about how lenders think about underwriting a deal.
And they all think a little bit differently.
Yeah,
So you kind of have to ask them like, hey, do you have a template that you want me to use?
Yep.
You have your spreadsheet. Maybe it's the one that we shared with you. And then you figure out like where your numbers go in their spreadsheet. Some of them might collapse down. Some of them might extend apart. But generally, you're going to want to ask each lender like how they're going to think about the deal and what they're most interested in. Some lenders are very interested in cash flow. Others are very interested in, say, the renovation plan or the management plan. So asking them like, what would make this deal look like a home run to you? Oh, you're most interested in operations. Well, let me submit more of like my business plan to you. Of course, I'll submit the financials, but I'll make sure I lean more heavily on the business plan. Others are just more interested in just like that straight spreadsheet. So knowing what your lender wants is important. Good question there.
Yeah. Was there one?
I think that
Go up a little bit there.
I think that was everything. I think we got to everything.
Okay.
Thank you guys for being here tonight. I hope you had a good time. It's always a pleasure to teach, to serve. If you have any questions, let us know. And hopefully we'll see some of you on Friday for our Secure Freedom Fund webinar. Would love to see many of you at Real Estate Real Life in September. Take a look at the website, because even if you're thinking like, gosh, my September's already scheduled and I can't get the travel time, we have an amazing virtual option where you are right there in the room with us. We can see you. We can see you in chat. We can unmute you and you can speak. We take you right along with a really sophisticated camera crew where you're right along with those property tours. It feels like you're just right there. We have Category 1 CME. If you're a physician, a nurse, some other healthcare professionals, we offer that as well. So take a look at that virtual option. If you're thinking maybe travel isn't in the cards for you in September, we would love to have you virtually and you get access to the recordings as well. That's a wrap.
That's a wrap.
That's a wrap. Good night, everyone. Thank you. Have a good night.